Good morning, everyone. I'm Brad Smith alongside Jared Blickery. This is Yahoo Finance Live. Let's get right to the three things that you need to know to start off your morning. First thing you need to know. JP Morgan CEO Jamie Dimon warns that the banking crisis is not over yet. In his closely watched annual letter to shareholders, the chief executive expressed caution about the state of the financial sector after the collapse of SVB and said there will be repercussions for years to come. He called for better banking regulation and wants to strengthen the smaller banks to benefit the entire system. The FDIC has said it will propose new rule changes in May while the Fed conducts its internal review process. Second thing you need to know, an unprecedented day for America. Former President Donald Trump will be arrested and arraigned on criminal charges at a New York City courthouse today. Sources tell Yahoo News that he has been charged with 34 felony counts for falsification of business records. The evidence for the underlying crime Trump committed, not clear just yet, will not be until the indictment is unsealed today. But it's believed that it's related to hush money that Trump paid to Stormy Daniels during the final weeks of the 2016 election. This is the first time in U.S. history that a former president has faced criminal charges. The third thing that you need to know, the oil market's still suggesting OPEC's surprise output cut as Wall Street and markets, they're watching and assessing the impact of the move on interest rate hikes and economic growth. Some of Wall Street analysts are boosting their forecast. Goldman Sachs increased its outlook by $5 a barrel for December of this year, and by $3 a barrel for December of next year. Investors are now shifting their focus to demand trends, while Treasury Secretary Yellen called OPEC's decision unconstructive amid the fight against inflation. Well, back to the first thing that you need to know this morning. JP Morgan CEO Jamie Dimon out with his closely watched annual shareholder letter. And in it, he warned that the banking crisis triggered by SVB is not over yet, and the U.S. economy will feel the effects for years to come. Jared, wide-ranging letter that Jamie Dimon dropped this morning here, and we'll break it down in a few different ways. But first and foremost, we got to talk about the banking elements that he really brought up to the top of the conversation here.
Yes, incredibly, the SVB risk and SVB events, as they're called. Let me just quote from the letter here. As I write this letter, the current crisis isn't over yet, but even when it is behind us, there will be repercussions for years to come. Importantly, recent events are nothing like what occurred during the 2008 global financial crisis. So I think that's an important distinction here, not really too much of a surprise here. But they're basically saying the stress testing mechanisms are not really up to snuff. They're kind of unrealistic. And also what he's saying in terms of solutions with the regional banks, he says he wants to strengthen the regional mid-sized community banks, which are essential to the American economic system, acknowledging the fact that JP Morgan has benefited from the deposit flight from these institutions, but also acknowledging that the big money center banks like JP Morgan not fit to handle certain community banking aspects. For sometimes you actually need somebody who lives down the street from you to manage your money. And also a really an important swipe, I think, against shadow banking. Now, we haven't heard a lot of this with respect to the SVB. This is kind of a relic of the 2008-2009 crisis, but it's still there. You have tremendous loan portfolios and amounts of credits that are held on the books of non-regulated financial entities. I'm not here to debate whether or not that should happen, but Jamie Dimon, for one, is saying that we need to make a decision whether these are going to be housed and incorporated into the banking system and then protected by the banking system as we know it, or if they're just going to linger out there and be these systemic risks potentially once every 10 or 15 years. So lots of wide-ranging topics there just with respect to banking that we've talked about so far.
Yeah, and furthermore, he went on saying regarding the current disruption in the banking system, the risks were hiding in plain sight, he said. Interest rate exposure, the fair value of held to maturity portfolios, and the amount of SVB's uninsured deposits were always known both to regulators and the marketplace. So what this also comes down to is how banks were caught flat-footed amid the rise in interest rates recently as well. And he says, instead, the recent rapid rise of interest rates placed heightened focus on the potential for rapid deterioration of the fair value of held-to-maturity portfolios, and in this case, the lack of stickiness in certain uninsured deposits. So we've all seen what's taken place since then. But he also goes on to say these failures really not good for banks of any size, as you were diving into there a moment ago as well. And those broader implications could be for years to come, as he mentions, if we do not have a concerted focus on this by policymakers and regulators as well right now to really shore up confidence in the banking system. And he goes on to lay out kind of several steps that need to be taken here. But of course, we can't dive into all of those, at least in this immediate brief period of time. But highly recommend going to check that out. He also talked about the consumer, and you flagged this morning too. Yeah,
we don't have a lot more time to spend on this, but very much saying that consumer spending has been 7 to 9% more than in the prior year, 23% more than pre-COVID-19. So he's basically saying the consumer is strong, but this can change. Unemployment is extremely low. Wages are going up, particularly at the low end. 10 years of home and stock price appreciation, yet he really lays out the risks, and he talks about QT, that's quantitative tightening, quite a bit. But he is saying that consumer excess savings, that is that kind of lifeline in the economy right now, that's going to go to zero by the end of the year. That speaks to recession risk. Got to move on. Yes, go ahead.
Yes, well, we got to hang on just briefly while we have that up on the screen here for our viewers here, because he went and laid out two particular things that, and there it is, kind of the economic issues here and now. And as we're talking about the consumer, we have to pair this with the economy, and says here and now, still good economy, but also the storm clouds ahead. One of the things that was focused in on that we've heard time and time again over the course of last earnings season, and you imagine it might rear its head in this earnings season as well, depending upon how it impacts some of the businesses that we're going to, of course, get those reports from. Any of the inflationary trade adjustments, unpredictable war. Elon Musk talked about this last earnings cycle as well. And then the energy and food crisis averted for now. But if there's a net to kind of take away from what Diamond is saying here on the economic front, is that for right now, still resilient, still resistant at least, and holding up. But at the same time, some of the larger storm clouds ahead, which has been downgraded from one of the hurricanes that he had talked about.
Right, last year.
Last year, exactly. And so that, no doubt, a good thing. Perhaps we can dive into more of the public policy side of what he had to say later on today with some of our guests here as well.
You bet, Brad. And former President Trump being charged later today with 34 felony counts for falsification of business records. That's according to exclusive reporting by Yahoo News' own chief investigative correspondent, Michael IXIC. And Michael joins us now alongside Steve Clemens, Semaphore founding editor at large. Thank you for both of you being here. Michael, this question goes to you. Let's start out here. What can we expect today, and what shouldn't we expect?
Well, Donald Trump, the former president, will surrender to the New York District Attorney's Office. He will be formally placed under arrest and then processed to be brought into a courtroom for his arraignment. He will not be handcuffed. We are told he will not have to be subjected to a mugshot. And the conclusion of the DA's office and court officials was neither was necessary. He's going to be surrounded by a phalanx of Secret Service agents who obviously would prevent him from fleeing, which is the stated reason for handcuffing a defendant prior to a judge weighing in on pretrial conditions. But that said, he is going to be formally arraigned on 34 felony charges. These are charges for falsification of business records with the intent to defraud, with the intent to conceal another underlying crime, which we believe to be the campaign finance violations growing out of the payments to Stormy Daniels. In one sense, this is a much stronger indictment than people expected. A lot of people were thinking this was going to be mostly misdemeanors with maybe a felony kicked in. It's all felony charges, no misdemeanors, we are told. On the other hand, it's going to rest all on that, what the New York Times and others have called an untested legal theory that you could cabin the falsification of business records with the underlying crime of a campaign finance violation to escalate it into a Class E felony. So there's going to be a lot of there's going to be a lot of people poring over the evidence here to see what Alvin Bragg has to support this. But it is clearly a much more serious matter than a lot of people were expecting.
Yeah, great work there, Michael, getting some of the exclusive details on the felony counts and what's been put forth thus far. Steve, I want to get your read in on this, especially considering that according to a Yahoo News YouGov poll, Americans, they are polarized over whether the indictment is motivated by a genuine desire to hold Trump accountable or political bias against Trump. With all of this considered, how could we see even more polarization among existing elected officials who are trying to figure out, okay, where they put their own tenor or positioning around this unprecedented event that's taking place, and how it could even kind of shift some of the conversation around key matters that are being voted on by some of those members right now?
Well, I mean, I think Michael framed it really beautifully, but the truth is, on the political side, if you're a Democrat, you're going to be overwhelmingly probably in favor of this legal process of holding Donald Trump accountable. And I have to say, many of those Democrats and many of the top tier Democrats that help run that party are uncomfortable with this case for the exact reasons that Michael laid out, that it's wobbly, it's untested, that the notion of, he said, of cabining some of these charges with this greater campaign finance charge. And let's just face it, campaign finance charges are not an everyday charge for Americans, so they can't necessarily relate to that. And so there's a problem there. Republicans overwhelmingly see this as political persecution and a political prosecution. That said, structurally, 23 jurors had to vote for this indictment. This is the way the American legal system is constructed. It's not one individual, Alvin Bragg, who's driving all of this. The case had to be made about the content of what's happening. I think the biggest shift politically, which has been interesting, is 2 weeks ago, Donald Trump was 8 points ahead of Governor Ron DeSantis. If you polled Republicans about who they wanted to lead the party, that distance has increased since Donald Trump has been indicted to 26 points. So Donald Trump is raising money, and his popularity right now in the Republican Party, when compared to other potential challengers, is surging right now. So by every count, despite Donald Trump being in the crosshairs of the law, this is helping his campaign and revitalizing him. You remember, just until recently, Rupert Murdoch, the essentially many aspects of the conservative Republican establishment were trying to peel away from Donald Trump. Now they really can't. And he's put himself right back in the center of the news, above the fold, spelling his name right. And the scandal does not seem to have created much political damage for him at all.
So, Michael, what do you think this means for the Republican Party if Trump is able to capitalize this as in fact, gaining in popularity right now? What does this say as to his tactics? And then what does this mean for the party?
Well, first of all, look, this is the charge that Donald Trump would like to be facing if he's going to be facing any criminal charges at all, because for all the reasons that Steve just laid out, the difficulties in proving the underlying campaign finance violation, which is, we should point out, the only time candidate has ever been charged with such a crime. It was John Edwards, and he got off, and the Justice Department dropped the case. So there's not a lot of clear precedent that this underlying crime that Alvin Bragg seems to be resting on. Now, we got to wait for the indictment. There may be other underlying crimes that we're not aware of, but if it is the campaign finance, that is that's going to be challenged vigorously. And it's unclear how that plays out. But I should point out, as much as Donald Trump is benefiting from this particular episode with Alvin Bragg, there are far more serious matters he's facing down the road. I mean, the Georgia investigation is in its final phases, and we are expecting charges coming out of that in perhaps in a month or two, certainly by the summer. And if our reporting is correct, Donald Trump is likely to be facing felony charges there that are going to look to people as a lot more serious, trying to pressure Georgia election officials to overturn the results of the 2020 election. And then, of course, you have Jack Smith, the special counsel, who seems to be aggressively pursuing both the Mar-a-Lago classified documents matter and the January 6th investigation as well. So I think that while Trump may get a big bounce from the events today, if and when those other charges start coming in, it's going to make it a lot dicier for Republicans who want to embrace him as their nominee for 2024.
And so, Steve, it seems like something, at least for how we're continuing to monitor this story, that the markets may react to in the future is how this shapes the GOP calculus for 2024 and whether Trump is running as a write-in candidate or just running his campaign and the GOP does not select him formally as their nominee, or if the GOP does select him as the nominee with some of the polling data that has come in his favor. So where do you believe that could ultimately net out at, especially as the markets are going to be continuing to track this too?
Yeah, I mean, I think it's a great point, but I think we've got to be careful here. I mean, I think, as Michael just described, these creeping indictment possibilities down the road, do they harm his solvency as a candidate or do they help his solvency within the GOP base? That's a hard thing to see right now. When you look at the distance between Donald Trump and the next highest candidates right now. And I got to remember, I used to watch, Michael and I both watched Hillary Clinton lose a 35-point lead to Barack Obama when they were running against each other in the primary. So you've got to be careful of these big leads.
Hard to see, but why wouldn't it be as easy as looking back to other elections?
When you look at the Republican Party and its choices right now, for me, it's very hard to see where any of the other GOP candidates, when they stack up and begin going through the process, come out at the end of the day ahead of Donald Trump. So the GOP, in my view, either ends up with Donald Trump. If he doesn't end up there, the big fear the Republican Party has is he's got such a big footprint in the country. Does he run unattached to the Republican Party? That, I think, is a real possibility. So I don't think anything we're seeing right now wakes the Republican Party up all of a sudden and says, we're going to walk away from Donald Trump. Now, maybe I'm wrong, but I just don't see that at this moment happening. If it did, and there is pathway, I think I see a lot of people running for vice president and for Secretary of Commerce. That's what I see in the Republican Party right now, until you see the dynamics based on, I don't see the legal dimensions of this current case. In fact, Donald Trump is fueled, I think, right now by the legal challenges. It's not the way gravity works in the independent world or the Democratic Party. Gravity works differently right now in the Republican Party, and I think we need to look at that as it is, and that's what how I think things are unfolding as we look at it today.
So for the party, why wouldn't it be as simple as looking back to what you can see in a loss in the 2020 general election and a loss in Senate runoffs, and then additionally looking at some of the candidates where it should have been
they don't believe they lost.
More contended.
You have to understand, they do not believe they lost. They don't believe they lost. They believe the election was stolen from them. It's a different dynamic. They believe the system is rigged against them, that the issues that they're seeing in the laws, the structures, the norms are not working in their favor because they're rigged. So I wish it wasn't that way. I wish everybody saw the rules and systems the same way, but they don't. So at least 35% of the Republican Party sees that. I think others are rational in the party and do see a problem. But right now, if somebody has 35% of that party and the next biggest person is, in the, high teens or low teens, that's a problem right now of getting any other outcome. Michael, I may have a different view, but that's the way I see it right now.
Mike, we're going to have to leave it there, actually, because we're crunched for time this morning.
I agree with everything Steven just said.
Wonderful. Very smart. Great brevity there. Thanks so much. Michael Isikoff, who is the Yahoo News chief investigative correspondent, and Steve Clemens, Semaphore founding editor at large. Gentlemen, thank you so much for the time this morning. Appreciate it.
Thank you.
Sure enough.
Switching gears here, oil prices still on the upswing this morning after jumping yesterday on the surprising announcement from OPEC Plus to cut production. Monday saw crude prices rise by more than 6%, steepest one-day increase in more than a year. The news is concerning for investors already worried about the economic outlook for the year ahead. If crude prices continue to rise, consumers could start to see higher gas prices at the pump, which would only make inflation matters a little bit worse. Still, today's national average gallon of gas hovers at around $3.50, far better than the $4.19 per gallon average from the same time last year. We'll have more on what the outlook for oil means for the overall economy coming up later. You don't want to miss it. Well, the ISM's latest Manufacturing Purchasing Managers Index, or PMI, as the kids call it, registered a reading of 46.3% for the month of March, the lowest since May of 2020. Monday's report also marked the first time since 2009 that all 10 sub-indexes of the report signaled contraction, meaning all indexes registered readings below 50%. You can read all about this in today's morning brief, written up by Miles Udlin, up now on the Yahoo Finance homepage. Now, we were taking a look at some of the data there, Jared, and I know that you've been tracking a few of the points around this specifically, but it all, or at least the recent reading signaling contraction, no doubt that's something investors should be keeping a close eye on here right now.
Yes, when everything is heading to the downside, and that means a reading of under 50 right here, that says a lot, especially since it hasn't happened since 2009. And just to get into some of the subcomponents here and why it might seem non-intuitive that less is worse, but new orders, if new orders are dropping, well, that's kind of obvious. You don't have as many orders for future goods. But then you get into inventories. If inventories are dropping, you would think that's a good thing because, well, they're working that off. But that probably indicates they don't have as many new orders or a backlog. So in fact, having a backlog is actually conducive to an economic expansion, new export orders, same deal there. I think the bottom line is we have in place what's probably, we're in the middle of an industrial recession right now, and we'll know in a couple more months if this continues to play out on that side. And then the question is, do we fall into an earnings recession? Because both of those precede usually, almost always, the actual economic recession that we talk about for the broader economy. And if that's expected later in the year, well, we might be seeing this evolve in the current quarter and the next, possibly the third as well. So important stuff to keep track of here. Yeah. All right, for more on all the recent data, economic data and investing, let's now welcome in Wei Li, BlackRock Global Chief Investment Strategist. Wei, thank you for being here today. We've been talking about some of the economic data that's coming out, and we're looking ahead to Friday's big payroll numbers. Just give us, please, your thoughts on how things are evolving here on the economic front, because we're always keeping an eye of what the Fed is thinking of them as well.
Absolutely. Hi there. Good morning. Thanks for having me. So indeed, the ISM manufacturing data was surprising on the downside. It's been steadily decreasing for months now, but now it's at the lowest level in 3 years. And what jumped out to me in those components that you just broke down is just how poor those new orders are. All of this reinforces our view that we are entering a recession. This is a recession foretold, and it is perhaps going to be exacerbated by the credit crunch that can come from the banking turmoil that is playing out in the U.S. And if you look at what markets are currently pricing with S&P 500 above 4,100, it's really pricing in growth to take off, and also central banks cutting rates to come to the rescue of the economy, which when you look at the kind of elevated inflation numbers, cue the PCE number last Friday and also CPI number coming up next week, it's hard to really expect central banks to be able to cut rates, right? So when you bring all of that together, in our view, the macro damage that we expect for the U.S. economy is not really being priced in by markets at this juncture, which is why we are modestly underweight U.S. equities at this moment, and we are positive and overweight on emerging markets at this juncture, which seem to be more fairly pricing in what is to come.
You know, even as we have kicked off the second quarter of this year, and looking back at all the things that the beginning of 2023 has brought, even the fireworks at the tail end with the banking crisis and turmoil that ensued, that still, as Jamie Dimon put it in his letter this morning, will have ramifications that we haven't seen the full breadth of to this point. We think about some of these surprises that we could potentially still see in the second quarter of this year and even further out into the rest of the year. What would be those surprises that you're keeping an eye on? Perhaps some of those anomaly type of events that you have to still safeguard against if you are an investor and trying to position your portfolio against some of those events?
We're trying to put our head around the magnitude of this credit crunch that could happen in response to the banking turmoil, right? So we're talking about the economics of deposit playing out and what that means for the funding cost for some of these regional banks, but also for lending appetite. Maybe they will have to rein in lending a little bit, and what does that mean for the demand side of the economy? What does that mean for credit creation? What does that mean for central bank response mechanism, right? So if we see greater demand destruction, perhaps it means a lower peak in terms of central bank rate hiking cycle. But given the inflationary dynamics, we do not think that they will be able to cut rates. So there are some disconnects between what we believe would transpire versus what markets are currently hoping and pricing for. I would also draw your attention to geopolitical developments, right? We talked about kind of the OPEC cut, and that's the latest kind of geopolitical development that has been playing out. But as focus has been very much on the banking turmoil, there have been also other geopolitical pieces playing out that normally would take a lot longer time, but now they are playing out within a much shorter period of time, pushing up oil prices, pushing up the pace of decoupling between spheres of influence between US and China. So that's something that I'm paying very close attention to as we think about the rest of the year. The last thing I would say to answer your question is fundamentals and earnings as we kick off the earnings season in less than 2 weeks' time. So far, if you look at markets year to date, it's been a very macro market, right? So you look at what's been driving US equity return, actually more than 90% of the return is explainable by the 7 large cap tech names. So it's been a very strong duration trade. Those long duration names responding well to markets pricing in cuts. But it is our belief that focus would shift to fundamentals, shift to earnings. And on that front, we're already seeing signs of margins compression, earnings contracting for the first time since late 2020. Markets have yet to take note of that, but those developments are happening. We're forecasting a mild earnings contraction. Is not quite in the price, and we're paying attention to that as well.
Well, let me ask you, so what do you expect for Q1 earnings season, which kicks off in about a week or two?
Absolutely. We are expecting earnings margin compression to further accelerate. There are signs of that coming through in response to higher funding cost, higher labor cost, and higher production cost. But there is more room for margin to fall. And at the same time, if you look at the fact that actually revenue growth is outpacing earnings growth, so we're essentially looking at negative operating leverage. That is set to continue as well. We also think that as we enter this recession foretold later this year, there is going to be greater dispersion within the equity market across sectors, but even within sectors, which is why we pay particular attention to companies, quality companies that are able to grow their earnings, that are able to generate free cash flow, that are able to withstand the higher cost of production and pass that through, so larger pricing power as we enter recession. So greater selectivity is key when it comes to investing, and greater expectation for dispersion as we enter the earnings season is what we would expect.
Wait, while we have you here as well, I'm just kind of thinking about some of the through lines that I've been drawing from your CEO, Larry Fink's, his annual letter, and talking about ESG, and particularly one of the things that jumped out to me, climate risk is investment risk. That also coming up during Jamie Dimon's investment and shareholder letter as well. When we think about how people can best position what the public policy needs to do in order to get ahead of climate risk, in order to best kind of invest and set their portfolio strategy going forward, what do you tell people who ask you about where they can insert a concerted or at least a smart climate approach into their own holdings too?
We do think that climate risk is investment risk, which is why in our capital market assumption, we incorporate the impact of climate change in our asset return forecast, which underpins our strategic sectorial preference for the likes of technology and healthcare in our strategic asset allocation. I would also say that last year, alongside energy sectors performing well, renewable energies have also been performing really well. So in the context of geopolitical fragmentation, we do believe that the transition in certain parts of the world could be accelerated. And the last thing I would say is that as we think about kind of this net zero transition, this net zero journey, there's no template. We have never done this before. So as we think about what that means for macro outlook and inflationary forecasts, we do believe that it represents a series of supply shocks that we also need to kind of protect our portfolios against. This is one of the reasons that we believe that inflation is likely going to settle at a level that is higher than the pre-pandemic level, which is also why we believe that inflation protecting your portfolio, especially over the longer term horizon, is critical.
BlackRock Global Chief Investment Strategist Wei Li. Wei, always great to get some of your time, and thanks for joining us here at the opening bell.
Thanks for having me.
Absolutely. Well, you were just taking a look at the opening bell there on Wall Street. Markets have officially opened up for this Tuesday trading session. There you're taking a look at the U.S. major averages. Jared, we're mixed right now. What are you seeing at the Wi-Fi Interactive?
That's right. Yesterday we were seeing the Dow outperforming the Nasdaq in the red, and today it's a flip. So topsy-turvy. We saw a lot of flips last year. Hopefully we're not returning to that macro environment. Here's a look at the sector action, and it's kind of a split field here. Looks like materials pulling up the rear, and then industrials and energy just barely negative. Energy was the best performer yesterday on that OPEC plus price production cut. But today, consumer discretionary, that's XLY, that is in the forefront, followed by tech, financials, and staples, all of those outperforming, but not by a lot. So really not seeing a whole lot of movement in the early going here. Here's my leaders and sentiment markets and momentum. That is an ETF that tracks whatever has been, I guess, surging to the upside or downside in the last 6 months. That's up 2%. So more of the same there. Byto, that's Bitcoin, ARK Innovation. Those are kind of outperforming. Not seeing a lot in terms of meaning there. Cannabis, MJ, that's the biggest loser to the downside, down 2%, followed by Chinese stocks, KWeb. Let's take a look inside the Chinese market here. And as it populates, we can see more red than green. Alibaba down just marginally. Baidu up 0.4%. And I'll just leave us on the Nasdaq 100 here. Lots of green on the screen. Tesla an outlier. That's up 1.6% after a disappointment yesterday.
All right, just the beginning of today's activity. We've got much more to keep tabs on, Jared. Coming up on the other side, though, Virgin Orbit shares. They are plummeting downward to earth after filing for bankruptcy. We're going to discuss that coming up next. Credit Suisse chairman apologizes to shareholders at its final annual meeting for the bank's demise, in which Credit Suisse eventually came to an agreement to be taken over by Swiss bank rival UBS. Jared, this was fiery. It was absolutely just kind of an outpouring of emotions from investors who were frustrated at the end of the day with the mismanagement, not just in this event, but it sounded like some of the events past were also kind of rearing their heads into the discussion as well, even as they were voicing some of those frustrations, but very much focused on what was taking place. And ultimately, they had said that they wanted to put all of their energy and efforts into turning the situation around and putting the bank back on track. Pains me that we didn't have the time to do so. And in that fateful week in March, our plans were disrupted. That coming from Mr. Lehman from Credit Suisse, ultimately there.
Yes, and does my heart go out to all the Credit Suisse shareholders? I'm just wondering who at this point is an existing Credit Suisse shareholder. Are we talking about retail crowd here? I don't think so. I think really it's about the institutional investors. Middle East is kind of a pay-for-play situation with a lot of these European banks. They take huge stakes in them to gain access. This was, you could say this was a long time coming. I don't think it was fait accompli, but you have a guy who had truly mismanaged the bank. Then he says he's truly sorry. Then he blames the messenger, saying social media digitalization fanned the flames of fear. Well, that's going to be the case in just about any panic or crisis, especially if it's caused by you in the first place. There's always going to be a magnification there. I don't have a lot of sympathy for the CEO, for the shareholders at this point. This has been a bank that's been battered and bruised for years for a lot of misdealings. All
right, another major company that we're tracking here on the day. We got to talk about AMC. AMC stock sinks as its preferred shares surge after the movie theater chain reached settlements to proceed with converting its AMC preferred equity units, also known as those APE units, into common shares here. And now this had been going on in terms of the proceedings for quite a bit here. And we remember last August specifically, when those APE units started to trade, ultimately as a response to try and shore up even more kind of fanfare or kind of an exclusive offering, if you will, for the most loyal of the AMC shareholders that wanted to get further into or next even more so of their portfolio interest into AMC and the meme stock frenzy that had ensued around it. But at the end of the day, this had really caused a divergence in the belief that management was actually doing the right thing here, because there was that dilution of shares that was also taking place.
I think that's the real thing, and that's what's been driving the share prices. And I think this opens the door, and I've seen some analyst commentary as well that supports this. I think this opens the door to greater shareholder dilution in the future. Sorry, but I just see that coming here, and this is kind of the gateway is just being swung open here. If we can go to the Wi-Fi Interactive, I do have the AMC common shares versus the preferred, and you can see the twists and turns that they've taken. This at the end, this is a percentage basis chart, so this doesn't mean that they've converged precisely. It's just kind of an artifact of the presentation, but just want to show you all the volatility. Sometimes they were moving in opposite directions, sometimes they were moving in the same direction, and now they are finally converging to the point where there's going to be some resolution. But I think this just opens the door toward more share issuance in the future, which means greater dilution, which means potentially lower share prices. Yeah. Got to move on to Virgin Orbit. Those shares plunging after the satellite company files for bankruptcy. This coming as Virgin Orbit became unsuccessful in obtaining enough funding to continue operations. And this is a function of the current economic environment, the way I'm seeing it, Brad. I mean, cost of capital is way up. You got to think, though, there are some idiosyncratic factors as well. They weren't able to execute. But so my point is, in this environment, any execution failures are just going to be magnified. And because of that, we're just going to have these incremental failures. These just added to the list here. Yeah,
the hazard of poor management.
Yes.
It becomes even more elucidated when you do have the type of environment like
we're going
right
out.
Now. Exactly. And so with all of that considered, I mean, this is a company that had struggled in its launch strategy. and in the entirety of how this company was going to become profitable in the future, being able to take satellites into orbit, create a business that would ultimately have them doing multiple launches a year, not even just multiple, hopefully, dozens if they had gotten it right and was able to replicate the process at the end of the day. However, as of recent, because of the failed launches, they had to, even in recent weeks, lay off 85% of their workforce, or furlough, cut 85% of its workforce, which only had about 750 people. But at the end of the day, still, that a considerable move for a company that was just not able to execute on the vision, backed by Sir Richard Branson, of course, and one of his Virgin kind of brands within that family of brands. Yeah, and I root for him personally, but this one didn't work out. Coming up, a deeper dive into the state of the consumer. We're going to discuss what to expect from Walmart's Investor Day with an analyst from D.A. Davidson. Up next. Welcome back. Walmart kicking off its annual investment community meeting in Florida. Executives from the company's CEO, Doug McMillon, to individual business unit CEOs within the company, they're going to gather to discuss Walmart's strategic plans for the year. And investors are locked in for announcements on any growth initiatives, cost savings plans, and that's especially as the event has a history of moving Walmart stock. And joining us now to discuss what we can expect from the retail giant is D.A. Davidson Company MD Senior Research Analyst Michael Baker. Michael, thank you for being with us today. Just some thoughts. In general, what should we expect for Walmart to say about the current quarter, and then all eyes focused on guidance, of course?
Yeah, well, and you're right. Not only does this tend to move Walmart stock, we think it tends to move the market in general, just being a consumer bellwether. You know, the quarter, we're seeing sort of mixed trends. Of course, we know the consumer's under a little bit of pressure for the quarter, but some of the data points we've seen that correlate well to Walmart's same-store sales have actually been pretty strong. So we know they're taking share. We wouldn't be surprised if it's a cautiously optimistic tone about the quarter. We don't really expect any big change in guidance for the quarter or the year, but think they're having a pretty good quarter. They came into the quarter with a little bit of momentum, and again, some of the data points have been pretty strong. We think that, you know, some of the key things we'll hear about, of course, all the analysts, including myself, will ask them about the state of the consumer, all the normal questions. Are you seeing an impact from lower tax refunds, from SNAP, inflation, et cetera? So there'll be a lot of focus on the consumer in general. And then we think there'll be a lot of, Walmart will bring it back to their own initiatives and their own growth plans for the year.
Michael, what could Walmart say about categorical purchasing right now that would really kind of rattle the rest of the retail industry, or at least put the rest of the retail trader out there, or traders investing in the retail sector, on notice for what they should expect from the other major players?
Well, we think Walmart is taking market share in non-discretionary categories. They're well positioned there. That's where they've historically been strong. We think that's where the mix is going this year. And so we would suspect that it'll be a little bit weaker in some of the more discretionary areas, consumer electronics, as an example, home, even apparel. Really, I don't think that's going to surprise anybody. I think that's what we're hearing, not necessarily across the board. There are some exceptions, but generally speaking, that's the expectation, and we think that's what Walmart will say. And that is good news for Walmart. They do well in environments where consumers are focused on everyday basic needs rather than more of the discretionary sales.
So how do you think that shows up in their margins? We were just talking to BlackRock's Wei Li earlier, and she was talking about the effect that labor costs and also goods costs, services costs are having across the board, not just retail and retail giants like Walmart. But how do you see this hitting Walmart in particular?
Well, so mix will be a margin pressure point this year, but there are offsets. Supply chain costs have come down quite a bit. We look at trucking spot rates and contract rates, and they're down double digits year over year. They're down almost as much as they were up a year ago. That'll be a positive. Remember, starting at about now, the next couple months, we're starting to cycle this massive apparel markdown situation that we had for our retail, Walmart included. As you cycle that, that'll be a margin benefit. Labor costs are still a pressure point, but perhaps less so this year than they were last year. Walmart's already brought their wages up, and they're at a point where we don't think there's that much in the way of increases ahead. So a lot of margin offsets to the pressure point because of the mix. So all in all, we think margins will be more flattish this year rather than down significantly last year. Also, one thing that Walmart will stress is a lot of their what they call their alternative businesses, a lot of their newer businesses, things like Walmart Connect, Walmart Illuminate, Walmart Plus, et cetera. Those are all higher margin businesses. And so not as big of a sales driver, but very high margins. And that helps offset some of the mix issues as well.
Is there a big investment that a company like Walmart can make at a time like this in perhaps a down environment, or even sensing purchasing opportunities of kind of smaller entities, companies that would need an injection of capital, or that would ultimately bolster the Walmart kind of portfolio of products and make that ecosystem even more compelling to some of their core customers at the end of the day?
Well, that's something Walmart's done quite a bit of. I mean, over the years, they've bought and sold many companies, and they're not afraid to take a risk. We think that the CapEx actually was up a little bit last year. We think it'll be elevated this year versus where it was maybe the 2 or 3 years prior to the pandemic. And we think most of that incremental investment is coming more on supply chain type things. That they really are investing in supply chain, and we think that's a smart thing to do. So we think that's where most of the incremental investments will be.
And final question here, we got time. I want to ask you about Walmart Plus and their competitive drive with Amazon and Amazon Prime, and then how that factors into their demographic push into wealthier, I would say, wealthier purchasers, wealthier consumers.
Yeah, I mean, I think they're a good competitor with Amazon. Really, Walmart's core demographic, if you will, is everybody. Well, everyone shops at Walmart. We're seeing a little bit of a push into a higher end demographic, but we think a lot of that is trade down. That's customer driven. Customers, even higher end customers, are looking for better deals, and they're finding that at Walmart. Walmart Plus is part of that. We think one area which is somewhat related, I suppose, where they've been a lot more competitive is Walmart Marketplace. Their 3P offering online, similar to what Amazon has done. It's taken Walmart a long time to get there, but we think they're much more competitive right now. They have something in the order of 400 million SKUs now online, including their marketplace. That's up from about 80 million a year and a half ago. So they've really increased there, and we think they're becoming much more competitive with Amazon on that online front.
I tell all my friends, really solid $16 golf shorts over at Walmart there. D.A. Davidson analyst Michael Baker. Michael, thanks so much for the time this morning.
Sure, happy to do it.
And coming up, the battle of Disney versus DeSantis. It's escalating. What Disney CEO Bob Iger had to say against and at the media giant shareholders meeting against Florida there next. The battle between Disney and Florida escalates after Disney CEO Bob Iger called Florida Governor Ron DeSantis' policies anti-business at the media giant's annual shareholders meeting. Yahoo Finance's Alexandra Canal joins us now. My goodness, he said he's being anti-Florida. That's fighting words right there. Anti-business,
anti-Florida, the drama continues. And this was one of the first times we've really heard Iger dive into this political firestorm. The CEO of Disney saying a company has freedom of speech just like individuals do, and that it was, quote, very wrong that DeSantis is attacking Disney for exercising that constitutional right. Of course, this all stems back to last year over Disney's unfavorable reaction to the so-called Don't Say Gay bill, which forbids instruction on sexual orientation and gender identity from kindergarten into third grade. In response to that, DeSantis took control over Disney's longstanding special tax district, formerly known as Reedy Creek. He appointed a new board, hand-selected those members. However, we found out last week that Disney signed a last-minute agreement to essentially render that new board powerless. In response to that, earlier on Monday, prior to the shareholder meeting, we found out that Governor DeSantis asked Florida's Inspector General to look into this. So a lot of back and forth here. Iger saying he doesn't understand why DeSantis is attacking Disney, especially considering the mutually beneficial relationship that Disney has with Florida. The company revealing that it plans to invest $17 billion at Walt Disney World over the next 10 years, which will equate to an estimated 13,000 jobs. He said it's always been a two-way street, but clearly tensions are escalating right now. Iger saying that, as a company, they're not going to weigh into every single issue. However, if it's an issue that affects their business or their employees, they're going to speak up and have an opinion about it.
I was just in Orlando this time last month. I mean, the power line rails are literally shaped in the shape of Mickey Mouse heads.
Yes.
Like that's how mutually beneficial it's been over years.
Absolutely. It's so beneficial. It's so intertwined. Iger saying, we've helped out Florida with taxes, with tourism, community service. And in the same vein, we've been very appreciative of all that Florida has given to us. But clearly, there's some tensions there that I think are going to continue.
As a kid, I always loved looking at the mouse holes, which were in place of manholes. So yes. But let me ask you, they discussed some other things at the meeting as well. Any details there?
Yeah, in terms of Disney's overall media strategy, Iger reiterating that streaming is at the core of that business. Because of that, Iger is very anti-third-party licensing. He says that it's important to keep that exclusivity of content, especially as Disney's streaming division looks to maintain and reach profitability by 2024 for Disney Plus specifically. He also said the company is focused on quality content over quantity content. And to that point, Disney is going to continue to lean on its most successful franchises and temples. There's going to be a live action Moana film. Dwayne Johnson revealed the news during the shareholder meeting, saying that he will be reprising his role of Maui. So that was really exciting for a lot of Disney fans out there. But the focus, guys, of this entire shareholder meeting was really on this battle with Ron DeSantis. And I was a bit surprised by that, especially considering there are so major questions out there in regards to the future of Hulu and ESPN. That was not addressed at all on this call.
Yeah, I mean, it begs the question of, especially considering the recent moves that we've seen by Disney and trying to be more cost conscious, cutting their metaverse division even within recent weeks as well, where that digital strategy will get even more prominence and focus as they are also kind of making sure that they're bringing people back into the parks and resorts experiences there and propping up even content that goes into the movie theater side of the business as well.
Yeah, and Iger really seemed to emphasize the parks business too. The new Tron ride that opens today in Walt Disney World. So that's a big feat that they're focused on. So parks was definitely a big focus, streaming a big focus. You mentioned some of those cost cutting initiatives. We already saw round one of those 7,000 job cuts. They're going to restructure the business into 3 different organizations, the parks, the entertainment division, and then ESPN will be its own standalone unit as well. So come this next earnings report, we're going to get specifics on all 3 of those divisions. So it seems like a new era of Disney. Iger is very clear that he wants to take this company to the next level. We'll see if we can get there, and we'll see how the shareholders react to that.
All right, we know you'll be tracking all things DIS. Yahoo Finance's own Ali Canal. Thanks so much, Ali.
Thank you.
And guys, coming up, what job openings mean for the state of the economy. We'll have some breaking labor market data. That's coming up next. Welcome back to Yahoo Finance Live. I'm Brad Smith alongside Jared Blickery. We've got some breaking economic data to get to kick off the hour as we're watching major averages mixed here on the day. We're keeping tabs on the JOLTS report here. The Dow, as of right now, you're seeing that flat but to the downside. S&P 500 still barely holding on to gains. The Nasdaq, that's up by about 0.1%. But getting into some of the data as the BLS figures are starting to come through here, Jared, it seems like, as of right now,
it looks like the job openings, they came in at 9.931 million, and that is a drop from the prior reading of 10.824 million. So almost a 1 million I would say person drop right there. The survey was looking for 1.5 million, so definitely light of that. And also the prior number, I'm just looking at the revision, was revised down from 1.8 million all the way down to 1.5 million. So looks like the revisions were going in the downward direction as well. Looking for some other details of the report, not finding them just yet. But just in general, I think a lot of attention on this report, especially ahead of what we're expecting in terms of non-farm payrolls this Friday. Another strong payrolls report, probably looking for about 200,000 payrolls there. But the implications for the economy are if there aren't as many job openings here, and this is a rather more lagging report than we usually get with respect to openings. This is covering the month of February, whereas which we get with respect to March is going to come this Friday. All in all, a little bit of a disappointment there on the job front. So we're going to be tuning into more coverage of this in the days ahead here. Do you have any thoughts of this, Brad?
Yeah, just as I'm kind of looking through some of these numbers, and yes, that is your reminder of our live coverage on Friday as the markets will be closed. However, you still have economic data that's going to be coming out on that monthly jobs report front here. But, you know, even as we're looking through this drop from the 10.8 million openings figure that we had seen during January, and for the February figure now looking at 9.93 million openings, that a considerable drop, especially versus the estimate was what was surveyed of 10.5 million and expected there. A huge drop here. And just continuing to look at some of the market reaction here on the day. I mean, we're positive across the board, a little bit of a nudge higher, just barely for the major averages here. But some of the details within this, the largest decreases in job openings, they were in professional and business services at 278,000 decline there. Healthcare and social assistance saw a decline of 150,000 jobs, and then transportation, warehousing, utilities saw a decline of 145,000 job openings as well. However, job openings did increase in, get this, construction. That was up by about 129,000
Really
positions.
interesting, because for me, that's a canary in the coal mine here.
Right.
We usually lose the manufacturing and construction jobs first. That's kind of the harbinger of recession, but we're not seeing that in construction. In fact, a lot of construction projects are still, having been booked years ago, are just now getting into full swing. So there may not be that pipeline for future construction jobs, but workers are being definitely put to task right now.
Yeah, and separation's a little changed here, we should note as well. That came in at about 5.8 million there. Rate little changed at about 3.7% is where the separations came in.
All right. Well, we want to be keen with investors as we're all assessing the health of the labor market following the upcoming jobs report as the Fed continues to look for easing in labor market tightness. But how will the road ahead, how is it going to look, and what is it going to take to get to the Fed's target goal? Here to discuss this and more is Roth MKM Chief Economist and Macro Strategist Michael Darda. Michael, thank you for joining us here today. You were just listening to us rattle off some statistics at these JOLTS numbers that came in. Just your first blush impression of them, and what are we expecting for Friday in the big monthly report for March?
Yeah, pleasure to join both of you. So I think we are losing cyclical momentum here. That is consistent with job openings. They're still at a high level historically, but they've been declining. And that's consistent also with that ISM data that we got for March yesterday. A bit of a miss on the headline, but more importantly, I would point out on the new orders component, that's a leading indicator, a more substantial miss, and really right on the cusp of levels that you would typically associate with recessions. And so to some degree, I think this is what the Fed wants to see in terms of the job openings faltering from very high levels in the labor market, which has been white hot, losing some steam. And in their framework, that's how they will pull inflation down over time, slowing aggregate demand loosening up this tight labor market, and then inflation follows with a lag.
Michael, to the best that we possibly can read into kind of our crystal ball, and perhaps you've got one here behind you. We don't see your dog picture, so maybe the crystal ball is back there somewhere. But we've been just trying to wrap our heads around what surprises could potentially rear their heads in the second quarter of this year, considering the surprises that were certainly plentiful to wrap up the first quarter of 2023. Do you believe that surprise would come on an economic basis, or would it just be in what companies are saying and what they're signaling and CEOs have on their docket?
Yeah, it's a great question, actually. So thus far, the surprises have really been the resiliency of the labor market. We've had very strong job growth, and obviously the inflationary pressures have been pretty sticky. But we do have a backdrop now of a banking crisis that just started weeks ago, and we don't really have any data that reflects that underlying crisis yet. But we do know that lending standards were tightening very sharply even before the banking strain started up in March. So that's likely to continue. Those lending standards are a pretty powerful set of leading indicators for everything from capital spending to employment. And so I think the surprise going forward in the next few quarters could be that the economy, drops off more than anticipated. And that could be a bit of a risk for the equity market because part of the business cycle is obviously earnings. So far, we've just been in a very gentle earnings recession. So equity markets have been propped up by falling market interest rates, and I think to some degree the pullback in the dollar exchange rate. But at the end of the day, if the earnings are not there, then we could have more problems for the equity market in front of us.
Well, and can you explain what that might look like? Because we got earnings season kicking off later in the middle of this month, not too far away here. These expectations, as you say, the bar has been pretty low. At what point do earnings revisions kick in either to the downside or to the upside, even though that seems the unlikely possibility here?
Yeah, it may not take much. I mean, thinking about previous recessions, typically forward earnings estimates are anywhere from 20 to 30% too high at cycle peaks. So there's certainly wide scope for disappointment on the earnings front. And keep in mind that this market this year has been driven by the strength in technology stocks. The Infotech Index has been a star performer. The problem is that the price to sales ratio on the Infotech Index is above 6 times. That's literally double the average of the last 2 decades. And so with these high valuations going into a potential earnings storm and recession, I think investors are going to have to buckle up here because it could be a bit of a bumpy ride.
Interesting. Okay, so signaling some turbulence there and casting kind of a larger question over whether or not the bounce that we've seen in some of the biggest movements to the downside during 2022 that has now risen or at least led to a slight rise for discretionary and technology here in 2023, whether or not that can actually continue. Would there be other parts of this market, though, that for a long-term investor, you would say, you know what, this is a no-brainer, absolutely, move into this sector or in one versus the other? Where would you kind of prioritize that decision?
Yeah, no doubt about it. So we've liked positions across the Treasury yield curve. There was a huge rise in interest rates, short-term and long-term, this past year. So now investors have a real return on everything from T-bills all the way out to the longer duration notes and bonds on the yield curve. So we continue to like treasuries across the yield curve. For equity sectors, I'll give you a sector that's a little bit boring, that's underperformed, or at least some people think it's boring. I actually think it's a good place to be right now. Healthcare, obviously an important sector, not super cyclical, so not as exposed to the vicissitudes of the business cycle, and it's underperformed this year, so the valuations are actually much more reasonable. So I would not be chasing the cyclical sectors that have outperformed, that have nosebleed valuations, just a very dangerous place to be. But let's keep it closer to the vest in the Treasury market and then the healthcare sector on the equity side.
Yeah, only boring until you really need it there, Michael. So we'll continue to watch those sectors. Thanks so much for giving us a little insight into how you're navigating this environment. MKM's Michael Darda. Thanks so much, Michael. Great to see you.
Thank you.
All right, guys, switching gears here. JP Morgan CEO Jamie Dimon, unsurprisingly, stealing the headlines with his annual letter. His brief to shareholders wasn't short on some doom and gloom, painting a picture of division at home and abroad, citing ongoing geopolitical instability and, of course, price pressures we haven't seen in decades. There was a silver lining around the so-called storm clouds, however, positive returns for the investment bank and a healthier-looking U.S. consumer. So the risks ahead, one issue in sharp relief, the prevalence of AI. So is JPM's 200-person research squad solving that for him? Yahoo Finance's Ali Garfinkel has the details. She's here on set with us. Ali, what did you have to say about artificial intelligence?
I got to tell you, Brad, for all the doom and gloom in this shareholder letter, Dimon's messaging on AI was very different. It was, we've got this. He was actually starting by giving some color on how JP Morgan is using that AI, right? And he was actually relatively specific. I would have wanted more specificity, but he did say there are 300 use cases in production today at JP Morgan. And they're in applications like marketing, prospecting, customer experience, fraud prevention. He even mentioned that payments processing and AI are going to be a really big deal for JP Morgan and are already. But why is this crucial to them, right? Yes, Dimon is responding to the cultural zeitgeist. Even he feels pressure to do that. And yes, I think he's looking for the benefits AI can offer, but he was also very direct about wanting the protection that AI can offer. He even said point blank, we're doing it because the bad guys are using it too. He didn't specify which bad guys he was referring to, but he was pretty clear he was worried about the security concerns if he doesn't adopt AI. That said, the impression I got was not a move fast, break things approach like we see in tech usually. It's a very banking-oriented approach. It's a very risk assessment-oriented approach. I actually would love to read you one of the quotes from this. We take the responsible use of AI very seriously and have an interdisciplinary team of ethicists helping us prevent unintended misuse, anticipate regulation, and promote trust with our clients, customers, and communities. So how do they do that, right, is the next obvious question.
Well, and the Meta used to have those people. I think they just fired them.
And JP Morgan picked them right up.
Yeah, I think, banking is supposed to be boring, I think, as we might agree here.
There are people who disagree. They say it needs to actually be more innovative.
Yeah, well, I think it should be more innovative, but at the same time, you don't want to hear about it in the news when everything blows up. That's my kind of boring banking that I want. But just in terms of the fintech landscape here, how is AI permeating it? We know JP Morgan, Jamie Dimon has to be on record because this is the next big thing and it's here, it's in the public forefront, but what's behind the scenes here?
Well, it's really interesting because you do get the sense that part of this was just him wanting to be on the record about AI. Yeah. But in terms of next steps, what's actually interesting is it's not about AI specifically at all. It's about building the infrastructure under which AI can exist. So for instance, he's talking a lot about cloud adoption, right? The company, for instance, has spent $2 billion on building cloud-focused data centers. And how that's said, though, it doesn't mean all the migration has happened. It doesn't mean all the app migration has happened. To date, the bank has migrated about 38% of its applications to the cloud, which
seems low.
Seems low, right? It's progress, but it's also definitely suggesting there's a ways to go here.
And they're probably way ahead of their big banking competition as well. So there's
you know you're going to be hearing other banks talking about this sooner rather than later if they're not already.
A little bit of FOMO.
Perhaps. Yahoo Finance's Ali Garfinkel, thanks so much for breaking this down for us. All things AI, as at least the gospel of AI according to banks. Thanks so much. All right, switching gears here. Let's talk one of our trending tickers or trending currency today. Dogecoin has been surging over the past 24 hours. You're taking a look at a move that we've been tracking after Elon Musk swapped out Twitter's blue bird icon with the Shiba Inu dog symbol associated with Dogecoin. The meme coin's tokens racked up roughly $26 million in liquidations in the past 24 hours, according to data from CoinGlass. Dogecoin currently enjoying its lead in gains compared to Bitcoin and Ethereum, or Ether, whatever you're calling it at home. Well, just call them not performing as well as Dogecoin over the past 24 hours. Coming up, how the surprising cuts from OPEC Plus will impact investors. We'll speak with a senior energy trader next.
oil prices spiking after OPEC Plus members announced a cut to production by an additional 1 million barrels per day.
Just taking a look at what Wall Street analysts are saying about this surprise announcement, they are basically now expecting oil to go up through the end of the year.
Yes, of course. Whenever you increase the price of the base product, crude oil, that goes into making gasoline, it's going to get worse. What has been a very slow-burning Cold War between Saudi Arabia and the United States.
We have to see how this OPEC news sort of trickles in, whether it will create winners and losers again based on the rise in oil prices.
Some people are pointing to this cut and saying, well, look, it's going to be taking so much production out of the market through the rest of this year. Regardless, OPEC is focused on stability in the market here. They don't want choppiness. They don't want volatility.
Elevated energy prices, another recession factor there.
Of course, the big question is what this means for the Fed's fight against inflation.
It actually sort of confirms that we're likely to see 2 25 basis point hikes. With oil prices likely to be moving higher, inflation will continue to be a thorn in the Fed's side. I think the real question is, how deep will the recession be? And I think one of the main factors will be how long does the Fed continue to raise rates?
It's time now for our chart of the day. In the wake of OPEC's production cuts, let's take a look at what countries have led the global energy market. On the supply side, cuts are expected to boost revenue for oil producers. Leading the pack in 2021, the United States, which accounts for a fifth of the world's oil production with nearly 19 billion barrels a day in 2021. The U.S. became the world's top crude oil producer in 2018 and maintained that lead position, coming in second place with 11% of the world's oil production, or roughly half of the U.S.'s share, is Saudi Arabia. Now, on the demand side, the biggest oil consumer in 2021 was the United States, consuming nearly 20 million barrels per day, about one more barrel than it produces, followed by China, which consumes 15% of the world's oil despite producing 5%. Now, in third place is India. It consumes 5% of the world's oil. Oil prices are moving higher, with energy stocks getting a lift as a result following OPEC's production cuts. Energy traders and economists are now analyzing the motivation for the cuts. Was it a power play by Saudi Arabia, or a signal that the group of oil-producing countries see weakness in Chinese demand? Joining us now to discuss is CIBC Private Wealth U.S. Senior Energy Trader Rebecca Babin. Rebecca, always a pleasure to have you here with us and get some of your insights on this. So perhaps you can help us start there. Was it just a power play, or was this a broader demand story?
So that is the question the market is currently grappling with. And there's kind of two schools of thoughts, as you mentioned, that they did this in response to what they see coming out of China as a weaker demand profile, whereas expectations are very high for Chinese demand throughout the course of the year, and that the US recession will be deeper than many have kind of projected. The second school of thought is that they saw the price action in March, where you had a 17% sell-off followed by a 12% rally, and realized that the market had succumbed to financial market players dictating price action, and price action moving away from fundamentals and more to financial instruments. And they really dislike that. So my thought is that this move is a combination of both. Primary driver, I believe, is a response to the market action they saw in March, where short sellers really dictated pricing, where fundamentals actually still remained fairly solid. And this is something they've really talked to in the past, particularly Saudi Arabia's energy minister. He has said, I want to make the shorts ouch like hell. This is a thematic kind of narrative throughout all of his press conferences. So I think that was primary. Secondary, I think this macro event has led to higher uncertainty about growth. And there is probably some concern from their end that demand might not end up being as strong. So they kind of killed two birds with one stone on the move, on this surprise move. I think the primary driver was taking the market by surprise and reminding everyone, especially the short sellers, they are in charge.
All right. We know this might have been an attack against the short sellers. There could be a response from the U.S. administration as well. Just wondering what cards, what quivers are, I guess, what arrows are in the quiver of a Biden administration at this point. You still have barrels in the Strategic Petroleum Reserve, although there have already been calls to replenish that from the previous drawdowns. There have been some measures about drilling in federal lands. Those haven't gone anywhere in the last couple of years. Just wondering, what is the, I guess, not only the jawboning that could be done, but actual measures that could be done in the U.S.?
So the jawboning, if you notice this time, is very different than the response from the U.S. is very different than what we saw when they put forth their cuts in October of 2020. The U.S. administration really responded aggressively to that. Obviously, it was part of a midterm election cycle. And this response has been a little bit more muted. I think that there will be continued comments that, as we saw from Janet Yellen, saying this was not constructive. And I think that will continue. I don't think it gets much more aggressive than that at this time. And I think the reason for that is they didn't get any results from really doing that. They had really pressured, except to weaken the relationship with Saudi Arabia, right? They jawboned, they took this very aggressive stance. They didn't get any response from Saudi Arabia to bring back production. So they're realizing that doesn't work. Maybe they need to be a little bit more collaborative and offer something else to try to get maybe production back online. So that strategy didn't work. I think they're going to use the media, obviously, to project they don't like this, but I don't think they take it to the next level. In terms of their tools, you said something very important. They can release more from the Strategic Petroleum Reserve. That is essentially their tool. They have already released a lot. It's getting to levels where we haven't seen since the 1980s. It would be controversial to do so. So I think they will really try to avoid doing that over the course of the next several months, but it's not out of the question. And just keep in mind, we actually currently have an SPR release coming over the next 3 months, 26 million barrels. So they are still, that was, pre-slated prior to this fiscal year, but we do still have SPR barrels coming into the market over the next couple of months.
Rebecca, even as we kind of look back at the stress that kind of permeated into the start of the second quarter and as seen through Jamie Dimon's letter this morning about the banking crisis and what that means for the surprise that could happen or the big surprise that could cause the markets stress or the economy stress in the second quarter, or even later on this year. Did that surprise just happen? Did this OPEC decision, was that the second quarter surprise that is ultimately going to be the stress factor for the macroeconomic scenario and seeing that plays out from this point forward through the rest of the year?
That's a tricky one. So I would say no. And the reason I say that is the reason that higher crude oil prices last year resulted in above $5 a gallon gasoline at the pump was because we had very constrained refining capacity. This year, we have refining capacity globally coming back online. So there is a little bit of a release valve, at least to a certain extent, that higher crude prices might not kind of compound into extraordinary prices at the pump. So because we have a little bit more refining capacity online, which helps the kind of impact of higher crude and not having as much of an effect on the consumer. However, I think if we get to points where there's a vacuum higher and crude goes above $100 a barrel, we could see obviously more reaction function from the Fed and a much more kind of impact on the economy. I don't think that's what Saudi Arabia is playing for. I think they're smarter than that. They will now have barrels to bring back to buffer, and I think they will be very, very fast to do so in the event that you get a price spike above 100. That is not good for them. It's not good for us because it ultimately kills the demand that they want to continue to see and stabilize. So I don't see it playing out that way. But it certainly is something on the risk horizon that everyone's thinking about and talking about. So it's not, you shouldn't just brush it under the rug, but I don't see it playing out.
Duly noted. CIBC Private Wealth U.S. Senior Energy Trader Rebecca Babin. Rebecca, thanks so much for the time and insights here today.
Thank you.
Absolutely. Coming up, Disney's Bob Iger had some strong words for Florida Governor Ron DeSantis. We spoke about that earlier, but we've got even more that you need to know from the Media Giants shareholder meeting. That's next. Disney's annual shareholder meeting promised big investment in the Sunshine State, even as CEO Bob Iger took several swings at Governor Ron DeSantis and called his recent moves anti-business. We're here with more now, joined by Brandon Nispel, who is the KeyBank Capital Markets Equity Research Strategist. Great to have you here with us this morning. All right, if there's any big takeaway that you were able to really kind of get from this shareholder meeting, what really stuck out to you?
Well, thanks for having me on. I think there's a couple of things. One being that the board is very focused on establishing a succession plan for Bob Iger. Two, Mr. Iger made a clear focus, I think, on transitioning the business towards its core franchises. And then just really reiterating the point that, Disney is sort of key to the state of Florida, and it's going to put a lot of investment dollars into the state and their theme park business, which has done really well for them over the years.
And let's just delve into that theme park business. Any additional commentary with regard to that? Because Florida, of course, takes a front stage in this when we think about the theme parks for Disney. But in fact, they have them around the world, and that has been a centerpiece, kind of a pillar of their business in the past.
Yeah, absolutely. I mean, I think the new comment that Bob Iger spoke about yesterday was that Disney would spend $17 billion over the next 10 years building out theme parks. Some of the data points that I thought were mentioned were a modest positive in that, Walt Disney World generates 50 million visitors this year and 8 million internationally. And I think where there's room to go is that international can continue to come back. That was a big thing. I mean, those parks are very profitable ever since Disney reopened them from the pandemic. They've been operating very efficiently, and they generate, the vast majority of the company's profitability.
Okay, and so for the other spaces and around the world that Disney is going to want to operate, it's not, of course, just the parks experience. It's how they can get the digital experience that they've been able to drive into those regions as well successfully. Were they able to add any more color about that and where they're seeing even more international pickup on their streaming side of the business even?
We really didn't hear a whole lot more about the Disney streaming business. From our perspective, Disney's core franchises generate vast amount of interest from consumers all across the globe. I think if we ask consumers in just about every country, they have a favorite Disney character. And that really is what drives our view on Disney. We think streaming is going to be a global distribution game, and Disney, from that perspective, should do really, really well.
And how does this parlay into the studios business, that vertical, and the release schedule for the upcoming years?
Well, I think the new announcement yesterday was that Moana would be coming back from a live action standpoint. Disney has ultimately a pretty wide breadth of content. And one of the things that I think has frustrated shareholders over the past couple of years is just that the cadence of that release slate is generally slow. So, we're looking for Disney and Bob Iger to come back and put a little bit of new spark behind that.
Now, the different thing going forward is how ESPN is going to be reported for. What detail, what color did they provide on that? And is there any more indication for how investors should be looking at this going forward?
Disney didn't really provide a lot of detail in terms of how ESPN will look. One of the things that we will be getting from Disney over the next couple of quarters is new segment disclosures, which will show the profitability of ESPN on a standalone basis. And we're really looking forward to that. From our perspective, the linear TV business is challenged. In the US, subscriber losses are in the 6-7% range. And we don't really see anything that's going to change that in the near term. However, as we look at it, sports and live news are the two really content genres that are going to do well in a streaming business. And obviously ESPN is heavily focused or 100% focused on sports. So we think Disney can outperform some of their peers.
We got time for another, and I'll give you the floor. Anything we didn't catch on that you'd like to touch on right now?
I think a lot of the pushback from shareholders was appropriate, along the lines of Disney's social and political standings. We do have a change in management, right? Bob Chapek did not leave the best taste in shareholders' mouth after, he left. With Mr. Iger coming back, I think there's reason to be optimistic.
And that optimism, does that translate into profitability? Is that a shoring up of margins that investors can expect now with Iger reassuming and considering all of the different demands that some of the more vocal activists had put forward towards Disney as well?
Yeah, well, I think the core business in itself is going to continue to grow from a revenue, from an operating income standpoint, and profits should improve, and primarily because we're going to get past the peak losses in the streaming business. I think what's added some optimism too is, this is a business that's going through a phase of restructuring. Disney's announced that they'll be eliminating 7,000 jobs. And as I look at Disney, in my cable media telecom coverage list, Disney is by far and away the fastest growing company that we cover and that we think will be growing over the next 3 years.
Disney, a growth story. There you go. Really appreciate your insights there. KeyBank Capital Markets Equity Research Analyst Brandon Nispel. Coming up, why OPEC Plus, their production cut could help Biden's debt ceiling problems. Yahoo Finance's Rick Newman has all the details. Up next. Welcome back. Earlier this week, OPEC Plus made a surprising decision to cut production, which pushed oil prices up by about $5 a barrel and to about $81 in the United States, with some forecasters seeing prices rising by another 10% or even 15%. But could this move actually be a gift to President Biden? Yahoo Finance's Rick Newman says yes, and he joins us now to explain. So,
hey guys.
Yes?
Maybe. So guess what? Republicans and Democrats actually do have at least one thing in common, which is they both want lower gasoline prices and lower energy prices. And OPEC Plus, by cutting production and pushing prices up, actually makes it harder in the United States. This actually gives Biden some top cover within the Democratic Party to do some things to promote domestic energy, domestic hydrocarbons. And Biden has been, a climate warrior, and he signed the big green energy bill last year. But Biden has also, kind of below the radar, he's been approving some the big drilling project in Alaska. He's allowed new drilling in the Gulf of Mexico. And it's possible that the way we get, this is a bank shot, but bear with me, it's possible that the way we get through the debt ceiling problem is there's a compromise on energy. Republicans made their first bill that passed the House, which the Republicans now control, was an energy bill that includes some things Biden's never going to go for, but it includes some other things that are fairly bipartisan, such as reforming permitting so we can build more pipelines, which, guess what, also necessary for green energy development. So some people watching, the inside baseball on Capitol Hill are saying, this may provide an opportunity where Republicans and Democrats can say, well, maybe there is a little something we agree on. Let's find ways to goose U.S. Fossil fuel production because we're not getting as much as we need from the rest of the world. So it's still very complicated how we're going to get through this, but this is a possible narrow avenue through the debt ceiling problem.
Interesting. And so with all of that considered, I mean, the calculus around how Biden would get this done, I mean, what are we talking about in negotiations? Is this something that could be resolved over days, weeks, or is there a larger push?
It's already been months.
Okay.
So it's going to be months, and it's going to go down to the wire. And the real deadline is when the Treasury just runs short of money, is probably midsummer or something like that. The way this is playing out right now is Republicans are saying we demand spending cuts in order to agree to increase the borrowing limit. But Republicans still have not said what those spending cuts are. And there has to be something that looks like a compromise. I mean, the Republicans need to be able to say, we got something out of this, even if it's not that much. So the thing that Republicans could get is they could get Biden and the Democrats to agree on some of their energy ideas. And if Biden and the Democrats were to say, maybe we will go a little further on these permitting reforms. I mean, it's really hard to build a natural gas pipeline in the United States. Some of that's local opposition, but some of it is federal opposition. And if, Biden were to say, okay, we'll agree to this, Biden can go to voters and say, look, I'm doing this to keep your energy prices down. And this is also how we got through, we raised the borrowing limit so we're not going to have, a financial catastrophe when the United States defaults on its debt. I mean, it's very complicated. There are a million moving parts, but this is, just like I said, it's a possible ray of daylight.
I think we'll take that, or at least traders will maybe take that. Rick, while we have you here, want to ask you about Trump and this list of 34 indictments expected to be handed down shortly, if not imminently. You're expecting something interesting. We were talking about this in the break.
I'm very intrigued by the reporting that there are not, 1 or 2 or 4 charges pending, but as many as 34 charges pending against Trump. So, to my mind, if there really are that many charges, I don't see how you get that many charges just based on one, or there actually were 2 hush money payments. It's possible that there are going to be charges relating to Trump's business practices. There's been a lot of investigation into whether Trump has committed business fraud, tax fraud, insurance fraud, bank fraud. And one of the things that he has done over time, and we know the Manhattan District Attorney's Office has looked at this, we don't know if they're going to charge it, but Trump repeatedly has overvalued properties for purposes of getting loans, and then undervalued them when it comes to paying taxes, and not by 10 or 15%, I mean by multiples. So one of the prosecutors who resigned from the DA's office wrote a book about this, outlined a lot of this. So those issues are there. we're going to find out very soon if that's part of what the Manhattan DA is charging Trump with.
No doubt an unprecedented moment here. We're going to be tracking any developments around it. Yahoo Finance's own Rick Newman. Thanks so much.
Thanks, guys.
Coming up, everyone, Tesla's delivery numbers raising concerns. Further price cuts to come, perhaps? We've got the details next. Concerns around Tesla are picking up speed after the EV maker's first quarter delivery numbers left investors questioning if additional price cuts would be necessary to drive sales. For more on the outlook for the auto space, we're joined by Cox Automotive senior economist and senior director of industry insights, Charlie Chesborough. Charlie, great to have you here. First, what is this signal about not just the EV market as a whole and where consumer pickup is taking place, but whether or not it's taking place at a lower price and what that means for the competitive landscape?
Well, we just got March sales in, and they looked fairly strong across the industry. There appears to be strong demand out there from consumers for EVs and basically everything that we can see, regardless of these high interest rates. And so I think that does spell good news for the industry, that if we do see a bit of a slowdown in the economy later this year, it's hard to point to anything in the data right now to suggest that we're starting to see a slowdown in vehicle sales and that consumers may be able to withstand these high rates and slowing economy and still buy these vehicles.
How much in terms of price cuts is left in the bag? Can Elon pull out of a hat if necessary, if it comes to that? And how does that affect the other auto players in the EV race?
Well, certainly we know that they have some production advantages and that they can, they've said that they can make some substantial savings with some of their production nuances that they have that some of their competitors do not. But I don't know how much more leeway that there really is. I mean, Tesla needs to get certain margins from these vehicles in the U.S. Investors are expecting it. And I don't know that there's much need right now for Tesla to cut their vehicle price, because I don't know that that's really the obstacle right now. I think consumers are still getting used to these EVs. They're trying to understand electric vehicles. They're worried about charging stations. So I think that there's still a lot of education that has to go on out there for consumers to really start gobbling up Tesla's EVs or anybody else's. And certainly the Inflation Reduction Act, which was passed last fall, is going to have huge implications for the electric vehicle market. And we're still trying to understand what those cost implications may be in terms of how those rebates are applied.
So in this interim period of time where consumers are still waiting for more details or at least proof that there's going to be a larger widespread network of charging stations available, how does that place more emphasis among the consumption and the number of buyers out there on the battery for each of these electric vehicles and where they're prioritizing how good of a battery one manufacturer has versus the other and the range of that battery?
Well, and I think that's an excellent question. I think consumers don't really understand what are the questions we should be asking when we're looking at buying an electric vehicle. Normally when we bought a gasoline vehicle, we didn't really ask too much about how far can I go on a tank of gas. But that's probably the most important question that consumers are asking around electric vehicles is how far can they go on a charge? And so I think that, again, that's one of the areas that the industry really has to educate consumers as to what their needs are going to be. Because we know that electric vehicles in general don't travel much over 300 miles. Some of the fancier ones and the ones that you pay up for have some of those features. But for most consumers, just being able to get around town and 200-300 miles may be plenty, maybe all that they need for range. But they don't know that yet. So again, that's one of the areas that consumers need to be educated about.
Well, when it comes to demand, a lot of that comes to affordability and the ability to take on new loans. And I'm reading your notes here. The average loan rate for a new vehicle edging toward 9%, listing prices above $47,000. At what point do consumer credit implications have a negative effect on here? I'm not necessarily asking for a repeat or your comparison to 2007, 8, and 9, but that's the most obvious example when we saw credit strains here. So what is that like and how does that affect the demand picture down the line with these elevated interest rates?
Well, one of the interesting things in the new vehicle market is a lot of those folks that would be very detrimentally hurt from these higher interest rates, your more subprime folks, your lower income buyers, they left the new vehicle market back in March of 2020. When COVID first struck, we lost a whole bunch of folks that were more of the lower FICO score buyers out of the new vehicle market. They could no longer afford these products. They had to move into the new vehicle market, and the industry pulled back significantly on incentives that would help get those folks into those products. And so that's really changed the landscape as to who remains in the new vehicle market is a higher FICO score, a higher income, more affluent buyer. They're able to withstand these higher interest rates. And that's why we've seen interest rates rise so substantially in the new vehicle market over the last year. And yet vehicle sales are up on a year-over-year basis. And so I don't think that the industry is quite as vulnerable today as we were back in 2007, 2008, because we've already lost a lot of the folks that we lost in the early days of the Great Recession. So if we do have a hit to the vehicle market this year, we've been telling folks that it's going to be more like falling off of a curb than falling off of a cliff.
Okay, I want to kind of pair what we've been talking about with Tesla with some of the legacy automakers here, because we've got numbers from Ford and GM. GM, of course, they put their off to a great start release details out there. More than 20,000 EVs that they've been able to start the year off with sales of. And then on Ford's side, looking through some of their numbers, they were able to see 10,000, nearly 11,000, 10,866 to be exact there, vehicles sold, electric vehicles sold in the first quarter of 2023. You know, as we think about how they're ramping up production, ramping up deliveries and sales ultimately, what is going to be the biggest selling factor or differentiator between these auto manufacturers as the legacies are going to talk about, you know, what their targets are to get to 2 million by 2026 for Ford and up against Tesla, who's been doing this and has brought the sexy component to EVs to the best extent that you can?
Well, I think for Ford, it all hinges on this F-150 Lightning. That's going to be their key product out there for the electric vehicle market. If consumers embrace those products and they can work out the kinks that they've had in production so far, that could be a real game changer for the industry, because certainly pickup trucks are an important product for the Detroit 3, and certainly the big segment here in the North American market. And if Ford has an EV solution for that, that could be a real game changer for them. But as I said, they haven't quite worked out all the kinks yet, and we don't know that the buyers out there have fully embraced these things. There's all kinds of talk about stated miles, stated ranges that you're going to get for the vehicle, but you don't get those same stated ranges when you're towing 3,000 pounds, or it's negative 10 degrees outside. So there's a lot of factors that can mitigate the range on that EV battery. And I think for pickup truck buyers that are using these products for heavy duty construction or work related, real task oriented work, they need to know exactly what these vehicles are capable of.
So in the search data, when somebody is originating a search and it is for an electric vehicle, do you see that they're within the data that they're looking for any opportunity to kind of optimize what that experience is looking like, whether that be in kind of more battery power so that they can go farther, whether that be in a sport package, or even opting into the heated seats at the end of the day? What does that search look like when someone's initiating it for an electric vehicle?
Well, I think one of the first things they're searching on is, can I get the $7,500 credit for this, or the rebate from the Inflation Reduction Act? And certainly price is the key ingredient when folks are looking at EVs. Is this something that I can afford? Is it in my wheelhouse? And so that's certainly an important factor. But right up there as well is the range of this product. How far can I go on this product? And I think one that doesn't get much attention, but I think as consumers get more and more savvy about electric vehicles, they're going to want to understand residual values. And how much of my value will this vehicle maintain over the course of its life?
Right.
Electric vehicles are relatively new. And with all of these rebates that are being implemented by the government, that's going to have a detrimental effect on residual values a few years from now. So I think that's an area that consumers are going to start asking about as well.
Cox Automotive senior economist, and senior director of industry insights. You've got all the senior titles here. Charlie Chesborough. Charlie, appreciate the time here today. Thanks so much.
Thanks for having me.
Definitely. We're also watching shares of DWAC today, known commonly as DWAC, as we await former President Trump's arraignment. This, of course, one of the ticker symbols tied to Truth Social. It's down by about 7.5% here on the day, Jared.
Yeah, so the Form 10K, that has to be filed annually with the firm's financials. They were not able to do that on time, so they filed for an automatic grace period of 15 days, and that's going to be granted here. So not the worst of all situations, but come 15 days from now, they're going to want to file that. Otherwise, it puts their listing in jeopardy. And we've seen huge volatility with this stock, with this SPAC that's come to market here. And so we'll have to see what comes of this. But reacting to the news that they were not able to file their financials on a timely fashion just yet.
All right, we'll continue to watch those shares. We've got some great interviews lined up all day here today on Yahoo Finance. Michelle Akufo will continue our coverage ahead of former President Trump's arraignment today. She'll speak with a professor from American University in the next hour.
That's right. And plus, you can delete your TikTok account. Yahoo Finance's Alexis Keenan and Dan Holly going to have a breakdown.
And later on, don't miss our 3 to 5 p.m. show. We've got Shauna Smith and Dave Briggs speaking to a former assistant U.S. attorney for the state of New York following former President Trump's arraignment at 2:15 p.m. You do not want to miss it. All that and much more today here. Here is a live shot of New York City.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Jamie Dimon stealing headlines with his annual brief to shareholders. Not short on doom and gloom, but there are silver linings in the shape of a healthier U.S. consumer. We talk recession fears and where we stand amid the uncertainty. And high security in Lower Manhattan today ahead of Donald Trump's expected arraignment. But what's likely to happen in the next few hours? Will there be a mugshot? Will the former president be released right afterwards? We'll have all the details just ahead. And got booster fatigue? You're probably not the only one. But is it worth staying the course on these piecemeal shots, or should you look to the one and done option? We get into that conversation with the CEO of GeoVax. But first, let's check in on the major indices this morning. They were in positive territory, but shortly after we saw that JOLTS data come in, we saw some selling action pick up. The Dow here now off about 160 points, about 0.5%. The S&P 500, they're also down about 1/3%. Tech-heavy Nasdaq there, down about 1/3% as well, or 35 points. Let's also check in on the Treasury market as we expect the Fed does have more work still to do. As you see there, the 5-year down almost 3% on the day, the 10-year down 1.75%, and the longer-term yields there down 1.1%. Well, let's start with the topic, animating market sentiment, the recession obsession. JP Morgan Chase CEO Jamie Dimon weighing in on the odds of a recession in his much-awaited letter to shareholders, citing recent bank failures, bond prices, and a bearish market. Now, in his letter, he says, quote, "The market's odds of a recession have increased, and while this is nothing like 2008, it's not clear when this current crisis will end." Now, that same uncertainty echoed throughout the market. Just take a listen.
Our base case as well is still one of recession. We had believed it was likely to occur in the second half of 2023.
It just implies that we are moving ever closer to a recession.
From the aggregate side, we do think that recession is unfortunately going to hit the US economy late in 2023.
How deep is the recession going to be? Very difficult to predict with precision. Any recession is going to be painful.
This isn't a downturn that we're expecting to rival anywhere close to what we saw for the Great Financial Crisis.
Well, let's take a deeper look at the commentary from Jamie Dimon and Fed officials like Neil Kashkari. Joining us now, Yahoo Finance's Alexandra Canal. Hey, Alex.
Hi, Rochelle. And yes, there seems to be this bearish sentiment sweeping across Wall Street right now when it comes to the possibility of a recession. Bank of America out with a recent note calling a recession a, quote, slam dunk. You mentioned Jamie Dimon and his annual letter. Dimon really drilling into that banking crisis, saying how many of the risks were hidden in plain sight, like the rising interest rates that we saw from the Fed. He said the current crisis is, quote, not yet over, and there will be repercussions from it for years to come. But one positive thing that he did note is that this was nothing like 2008. He wrote, quote, "This current banking crisis involves far fewer financial players and fewer issues that need to be resolved." That being said, we heard from other regulators like Minneapolis Fed President Neil Kashkari. He said that recent banking turmoil has indeed increased the risk for a recession. He told CBS's Face the Nation that these recent stresses, quote, definitely bring us closer, although he did say it's too early to make any predictions about what this means for the future of interest rates as well as the broader economy at this point in time. And then finally, one data point that I do want to bring up is the ISM's latest manufacturing purchasing managers index, otherwise known as PMI. That registered a reading of 46.3, the lowest since May of 2020. Even more worrisome than that is Monday's report marked the first time since 2009 that all 10 sub-indexes signaled contraction, meaning all indexes registered readings below 50. And we know that whenever investors hear a comparison to 2008 or 2009, there are many jitters. So tough times likely lie ahead here. And even though stocks seem to have essentially canceled a recession in the first quarter, a new JPM note warned that stocks are in a, quote, calm before the storm. So we'll have to see what this means moving forward.
And we know that Jamie Dimon does like his storm analogies, but even as recession fears loom, what did he say about the state of the consumer?
Well, the state of the consumer, at least according to Diamond, is particularly strong. And he highlighted several things going on in the economy to really drive that point down. We have spending up, balance sheets are strong, businesses are healthy with credit losses low. And that's on top of a very tight labor market, rising wages, the supply chain, which was a big concern during COVID, that has been recovering nicely. So overall, despite these future fears, the economy is healthy. You mentioned the fact that he likes his storm analogies, and 10 months ago, he did say a hurricane was coming. In this letter, he downgraded that to storm clouds, which could dissipate and be nothing. But I think what's clouding, no pun intended, an otherwise sunny outlook are these recession fears, is the fact that we have been experiencing this banking crisis. And, you know, with rising interest rates and everything going on in the economy, there is this level of uncertainty. So that is something that I think everyone on Wall Street is monitoring very closely, especially these top banking CEOs.
Indeed, and a lot of shifting sands, even in the geopolitical landscape that he noted, could be some seismic shifts there as well, depending on how these allegiances play out. Great stuff there. Thank you so much, Alexandra Canal, there for us. All right, well, data out this morning offered much needed clarity on the state of labor, with the job openings falling below 10 million for the first time since 2021. With a look at what this means for the wider labor market, I'm joined by Nick Bunker, Head of Economic Research at Indeed Hiring Lab. Good to have you on, Nick. So as we look at this JOLTS data that came out this morning, job openings falling, decreasing to 9.9 million, quits edged up, layoffs and discharges, though, decreased a little bit. How would you characterize the state of the labor market right now?
So we're still in a very hot, a very strong labor market, even if there is easing demand for new hires. That's why you're seeing the job openings number come down and why quits has moderated over the last year or so. But as you said, layoffs are still quite low. In fact, they're still still below their 2019 average back of 1.2%. So we're seeing a labor market where employers are adding fewer workers, even though unemployment is still low and layoffs are still dormant for the most part. So I think this is one where folks can expect to hold on to their job, but maybe not find one as easily as they were last year.
And it is worth noting that clarity there, because obviously a lot of these tech layoffs get the biggest headlines. But when you look below the surface there, in the Indeed notes, you have that layoffs, total monthly layoffs are actually about 16% below the pre-pandemic average. So which sectors then are seeing the strongest demand for employees right now?
So I think there's two broad sectors that are seeing demand still elevated. One is a lot of these in-person lower wage sectors that got hit hardest by the pandemic, but are still rebounding from that. So think about accommodation, food services, bars, restaurants, hotels. Demand's still strong there. You're also still seeing some relatively strong demand in some sectors like transportation and warehousing and utilities. There's still some underlying demand, even if things have moderated there a little bit. And I think, as you said, the tech sector gets a lot of attention and press, but it's definitely not representative of what we're seeing overall in the U.S. labor market right now.
And something that was interesting that you noted, the benefits and perks, usually that's a way for employers to sort of, entice employees to come in. But you're seeing that the data showing that advertising those benefits has leveled off. What does that signal?
So I think it signals that not only are there fewer opportunities out there for job seekers to find a new job, but the competition that employers are going through to fill those positions is moderating as well. Like you said, these sort of benefits or non-cash benefits of jobs, employers seem to be using them to sort of attract folks to apply for their job, to compete for those new hires. And while they haven't reversed, the rate at which they're advertised has slowed down, suggesting that employers are feeling less of a need to sort of advertise the benefits of their job in many ways in order to get folks in the door. So while that demand might still be strong in, say, a quantity measure, if you look at some of these other attributes, things are moderating a bit more than that headline number would have you believe.
So then what does that mean for the wage growth picture? You have the nominal wage growth versus the real wage growth, which accounts for inflation. We did see some softening there. Is the bargaining position of some of these employees starting to shift then?
It is. So not only do you see, wage growth is moderating. We're seeing that in a variety of metrics. I think one measure that came out this morning that's quite relevant for that is the quits rate. 10 months ago, it was 9.9%. most of the time when people are quitting their old job, it's to go ahead to a new one, and they're getting a raise for doing so. And one thing you can see in a couple statistics is that the gains to switching jobs have moderated over the past several months, suggesting that people might be switching jobs still at an elevated rate compared to 2019, but they're not getting the same sort of wage boost that they were late in 2022, late in 2021 or early in 2022. So that there is some sense that likely we'll see wages continue to moderate, but they're still growing quicker than they were back in 2019. So at least in nominal terms, wage growth is still strong, even if it's starting to cool off.
And something I want to look at, obviously, we've been talking a lot about recession this morning, recession fears, whether or not that would spur more people to enter the job market. And the employment to population ratio for workers aged 25 to 54, that's usually a good gauge of the health of a labor market. That stood at 80.5% in February. But if you're a new person entering this market, obviously graduation season coming, what sort of labor market are they walking into?
So I think if you are, it also I think depends on sort of where you're graduating from. So if you're a college grad, things might not be as rosy as they were, say, last year, particularly as we are seeing some of the pullback in job postings, at least on Indeed, tend to be for these more higher wage in office or remote work type jobs that might be a stepping stone for folks who are just graduating college. Now, it's still strong compared to 2019, but not quite last year. But I think if you're, say, graduating from high school, want to enter the workforce right away, labor market's still really strong. There's still lots of opportunities out there, and wage growth is quite strong there as well. So I think compared to, say, graduates of 2009, 2010, things are much stronger, but I don't think for many folks entering the labor market right now that things are going to be as opportunistic as they were back in 2022.
All right, plan your strategy then for your next job. Nick Bunker there, Head of Economic Research at Indeed Hiring Lab. Thank you so much for joining us this morning. All right, taking a look at Etsy shares in focus today after Piper Sandler upgraded the stock to overweight from neutral. That's amid a reacceleration in active buyer growth. You see they're up almost 2% on the day. Edward Yeroma, the analyst behind the upgrade, noted that, quote, while macro conditions remain pressured and consumer spending may be tipping to the downside, we believe Etsy has growth company characteristics. Definitely one to watch. All right, stay with us. Coming up on different pages, JPM's Marko Kolanovic sticks to the bank's underweight call on equities, but it's a different story over at Fundstrat. It says catalysts for stocks to decline have passed. Confused? Well, we'll break it down for you next. The rally in equities we've seen so far this year is likely to come to a halt, JP Morgan is warning. This in thanks to headwinds from bank chaos, an oil shock, and slowing growth. Yahoo Finance's Ines Ferrer is here with the latest. Hey, Ines.
Hi, Rochelle. And Rochelle, some market watchers are flashing a yellow warning sign when it comes to the market's recent rally. In a client note, JP Morgan analyst Marko Kolanovic reminds investors, quote, the Fed has made no indication of rate cuts this year, but risk assets are exhibiting an unprecedented rally. European stocks are trading near all-time highs, and U.S. stocks are recovering from recent losses. That's what this analyst has written. And he also goes on to say, we expect a reversal in risk sentiment and the market retesting last year's low over the coming months. The analyst also says the recent rise in stocks make little sense and was most likely driven by systematic investors, a short squeeze, and also a drop in the volatility index, or the VIX, below the 20 level, he goes on to say. Also, Kolanovic saying that the Fed still has ground to cover on fighting inflation and pushing back against the market's assumption of cuts, so the original source of stress, rates higher for longer, can re-enter the picture, Rochelle.
So Ines, on the other side of the spectrum, in a more bullish view, FundStrat's Tom Lee is expecting a strong April for equities. What can you tell us about that forecast?
Yeah, so Tom Lee and his team of researchers are expecting April to be the strongest month of 2023. FundStrat says that the S&P 500 could surge more than 4% this month. That's based on historical data, which the investment research firm has analyzed, and using what they call the rule of first 5 days, when the S&P 500 gained in the first 5 trading days of the year after it was negative in the prior year. And that's a scenario that's in play this year. The S&P 500 was up 1.4% in the first 5 days of trading this year after losing almost 20% last year. And this has happened only 7 times since 1950. And the win ratio for stocks in April was 86% during those times. So Tom Lee and his team at FundStrat also pointing to several factors that are supporting equities. Those include the VIX below 20, as I was mentioning earlier, a banking crisis, which so far appears to be over or subsiding, and regional bank deposits, which saw a huge outflow in March, appear to have stabilized, Rochelle. So 2 definitely different forecasts there.
Certainly tough for investors to break it down themselves as well. Great stuff there. Ines Ferrer there for us.
Thank you.
All right, continuing our conversation on the markets now. As investors consider whether to remain bullish on risky assets, the Fed makes it clear that elevated interest rates are here to stay. Markets are coming around to that idea, but here's how to position yourself defensively. Joining us now, James Denmott there, Main Street Research Chief Investment Officer. Thank you so much for joining us, James. So trying to make some sense of this, obviously we heard a bit differently from Jamie Dimon about the risks that he's seeing, but still this rally that we're seeing into this year. Is now the time to be bullish on these risk assets?
Yeah, a good question. And this rally to us looks a lot like the previous bear market rallies we've had for the last 15 months. Very narrow leadership. You got a VIX all of a sudden gotten really complacent again. And I think the problem here, and where investors really want to be careful, is that you've got Fed policy that's probably going to continue to be tightening right into economic data, like the labor market cooling today. That data is another sign, or the earnings coming out in the next couple of weeks. I think are going to start to show a lot of weakness in the economy. And you take that and it collides with tight Fed policy. I think we're going to look back and say, yep, this was another bear market rally. But I will say one thing, we are getting a lot of progress done on this bear market. I'd say we're in the last phase of it, and but that can sometimes be the ugly part.
So then, James, I mean, what does Fed policy suggest about when this bear market will turn?
Well, when it comes to Fed policy, they usually turn after they've broken more than what's broken already, which would be those banks that were, I would say, somewhat mismanaged. I think in the past, what you've seen historically, that by the time the Fed pivots, they've sort of already pushed the economy, into some level of recession. And this one, we would suggest, is probably going to be a relatively soft recession. But I don't think the Fed is very adamant about looking at backward data. And that backward data says inflation is real sticky around 6%. So the chances of them continuing to raise into economic weakness, sort of puts us in a position where, recession becomes a much higher likelihood. And the problem with equities really here is that they're just not priced for that. You're at 18 times next year's earnings. And that is not really where you would want to find the bottom of the market.
And every once in a while, we get a bit of news we weren't expecting. For example, the output cut that we saw from OPEC Plus, that sent oil back above $80 a barrel. And we know that energy has been one of the worst S&P performers of the year. But you're saying that it's been ignored as a sector that you like. What do you think investors are missing here?
Yeah, I think that they're missing a few things. I mean, China coming back online and basically the valuation of those stocks relative to the rest of the market still says, very reasonably priced relative to forward earnings growth. And that's really what we do at our place is we look at individual stocks and we look for opportunities where there's value and consistency in earnings and a good growth outlook. And in the complex, energy complex is well priced with very good forward-looking earnings in a macro environment that might get weaker sooner than later. But these stocks, like the rest of the market, once this last bear market phase is over with, are going to be a place you want to be going forward.
And you also like consumer staples, healthcare, utilities as well. All have been under pressure so far this year. How are you allocating those in the portfolio?
Yeah, and all these bear market rallies, these defensive positions that we have in healthcare staples have obviously underperformed in each of the bear market rallies. And that's because everyone's sort of going risk on. And then what you find is the market turns over, goes to a new low, and this is where, you're sort of in the island of safety. And that's what's so frustrating about being, a defensive investor during bear markets, which is really what our brand is about, sort of keeping investors' capital safe, being in those sectors that survive the bear market better. And if you look back, the staples, the healthcare and utilities, maybe a bad couple of months, but they've been the stellar performers for the 15 months of the bear market. And we think they will continue to be in this last phase. You'll see a rotation back to those sectors. But at the same time, we're sort of at the end of this last phase of the bear market. I think investors should make a list of great companies that might do real well in the new bull market that we anticipate, which I think, frankly, is probably in the back half of this year.
And what are some of the factors that would go into those picks?
I think some of the factors are really related to when stocks are priced at a point of maximum pain. You've already seen a lot of that in technology, where we're very interested in technology stocks here after many of them have been really hit hard. And we think, if this bear market has that last phase, that would be certainly a place we'd want to go to the highest quality names, where the price earnings ratio relative to earnings growth coming out of recession would look really attractive. So we're making a list, checking it twice, of great tech names. And it's not even a bad idea to tip your toe into buying some shares now and maybe buying more on weakness. The industrial sector, also very attractive, something, again, we've not been investors in, as well as the telecom space, I think is very attractive. But again, you want to sort of be a little bit more careful that the bear market has kind of cleared all the decks before you could kind of roll into those sectors. So right now, stay defensive, have less stock than normal, but make that wish list, because I think this last phase is going to create some great opportunities.
As you said, make that list. Check it twice, though. Certainly some caution there with that as well. James Demmert, Main Street Research Chief Investment Officer, thank you for your time today.
Thank you.
All right, coming up, high security in Lower Manhattan ahead of Donald Trump's expected arrest. But what's likely to happen in the next few hours? Will there be a mugshot? Will the former president be released right afterwards? All those details coming up on the other side. There are now numerous reports at the moment that former President Donald Trump's indictment contains something of 34 charges. To some, that may seem excessive to only be related to hush money payments. We know that President Trump has faced numerous fraud allegations over the years, so could there be more severe charges as well? Here to weigh in is Yahoo Finance senior columnist Rick Newman. Hey, Rick.
Hey, Rochelle, that's what I'm paying most attention to is what are the charges? I mean, all the sort of speculation about these charges has focused on hush money payments to either one or two women that occurred in 2016 when Trump was running for president. But if there are 34 charges, as much of the reporting now suggests, it seems like there has to be more in there than just these hush money payments. We know that prosecutors at the Manhattan District Attorney's Office, they have looked into allegations of bank fraud, tax fraud, insurance fraud, business fraud with regard to Donald Trump. There's been a lot of public reporting on this. And there is this civil case that the New York State Attorney General has brought against Donald Trump for many of those same charges, just at a civil level rather than at a criminal level. And those two offices have been working in tandem and sharing a lot of information. So that's the main thing I'm looking for when we finally get this indictment today is what are the charges? Are they going to go beyond hush money payments and actually look deeply into Trump's business practices over a course of many years?
And Rick, with so much build-up ahead of this, what can we expect in regards to arraignment procedures for the former president?
Well, it's going to be a media circus. It already is, although it sounds now as if there is not going to be a mugshot of Donald Trump. There's been a lot of speculation about that. And even some political analysts have said if there is a mugshot of Donald Trump, I mean, you always wonder how someone's going to pose when they have to get a mugshot taken. Would he smile? Would he give thumbs up? Would he be allowed to give thumbs up? And might he use his own mugshot as a campaign gimmick? Now it sounds like there will not be a mugshot. There doesn't have to be. And I guess the prosecutors normally do that if a suspect flees so that you can give the picture out so everybody knows what he looks like. I think everybody knows what Donald Trump looks like, and that's not going to be an issue. So he'll get through this at some point today. He will probably go right back home to Florida. And then Trump is supposed to speak tonight about the whole thing. And you can bet that's going to be quite an extravaganza.
Indeed. I mean, there aren't going to be cameras, from what I understand, publicly that people can watch inside the arraignment. So we'll have to see what he says at the rally to at least get his version of what happened there and where they go from here. Rick Newman, thank you so much for that update. All right, well, as we've mentioned there, Donald Trump is expected to surrender to authorities in Manhattan later today. The first ever charges against a former American president are now expected to weigh on the country and more specifically, the 2024 presidential race. Here to weigh in is distinguished professor at American University's Department of History, Alan Lichtman. Thank you so much for joining me this morning, Alan. Obviously, unprecedented times that we're in at the moment. Talk about what's going to happen in the next few hours and how important it is in terms of how the Republican Party responds right now.
It's extremely important. I'm going to read you a quote to put this all in perspective. Quote, "We cannot have one law for the ruler and another for the ruled. If that understanding is lost, the American democratic experiment and the freedom it guarantees is in jeopardy." Pretty strong statement that there should be no special treatment for a president or a former president. You may think that's some Democrat attacking Republicans today. It is not. It is a quotation from U.S. Representative Henry Hyde back in the 1990s, referring to crimes, allegations against then President Bill Clinton. And now Republicans have pivoted 180 degrees and somehow suggested that because Donald Trump is a former president, that he is entitled to special privilege. And the truth is, Donald Trump can huff and he can puff, but he's not going to blow the courthouse down. These charges, and I agree with Rick, they may be far more serious than even mainstream commentators have indicated, are going to rise and fall on the strength of the evidence, not on Donald Trump's bluster.
I mean, we've still seen that campaign dollars continuing to pour in for Trump at the moment. But in terms of the charges themselves and some of the support that members of the GOP, how are they trying to position themselves here? Because obviously they don't want to risk, the ire of Donald Trump here, but they're also looking ahead to the 2024 race.
Yeah, they've forgotten nothing but learned nothing. Let's not forget that Donald Trump endorsed candidates, election deniers, were virtually wiped out in the 2022 midterms. Whining and complaining and trying to relitigate 2020 is a dead losing strategy for Republicans. And most shamefully, not just Donald Trump, but an array of Republicans have reprised some of the oldest and worst anti-Semitic and racist stereotypes, charging that the black DA Bragg, who, by the way, is a Harvard Law graduate and a former assistant U.S. attorney, is being manipulated by the Jewish financier George Soros. This is one of the worst and oldest stereotypes, that scheming Jews are unscrupulously trying to control the country and using unwitting black people as their tools. How far has the party of Lincoln sunk?
So then what does this mean? How does this set us up for the 2024 election campaign season? And how should Democrats be responding to this as well?
Well, I think, as Napoleon once said, never interrupt your enemy when they're making a mistake. I think Democrats and the president are very smart, not jumping into the middle of this. Republicans are damaging themselves enough. And, if you look at Ron DeSantis, Mike Pence, and other potential Republican candidates, they have just sniveled at the feet of Donald Trump. They're supposed to represent the party of personal responsibility and personal morality. It has now become a joke. And the result is none of them have any viability right now in a Republican primary. But it would be very different if Donald Trump got nominated and then had to face a general electorate. 60%, according to a CNN poll, approve of this indictment. And this is likely to be one of maybe the least serious indictments. He faces jeopardy for undermining our national security through classified documents, for inciting an insurrection to overturn our democracy, and for tampering with a free and fair election in Georgia. He has a lot on his plate. And let's not forget, here in New York, the Trump Organization, which is Donald Trump, was found to be operating a criminal enterprise and had to pay the maximum New York State fine.
And Alan, I do just quickly want to get to this keys to the White House, the 13 factors that you look out that have accurately predicted presidential election outcomes since, I believe, 1980. I believe there was a little bit of a glitch there with Al Gore there. Is anyone then well positioned in the GOP based on these factors that you think could really take the nomination if it's not Donald Trump?
Well, the beauty of the keys, and they're very counterintuitive, but they've worked since 1984. And I can explain why I was right in 2000, but we're not going to get into that. The elections turn not on the identity of the challenger, but on the strength and performance of the White House party. If the electorate thinks that the Biden administration has done a good enough job and their party is strong enough, they'll get another 4 years. And I will give you a little bit of inside information. For all of the, hue and cry that Biden is too old, shouldn't run again, the best chance for Democrats to win in the next election is for Biden to run again, because he would secure 2 of my 13 keys that would otherwise be lost, the sitting president key and the internal party fight key.
We'll certainly be keeping track of that, and know we'll be checking back with you. We do appreciate you joining me this morning. American University's Distinguished Professor of History, Alan Lichtman, thank you so much for joining me on Yahoo Finance.
My pleasure. Take care. You know where to find me.
Indeed. Thank you. All right, coming up, got booster fatigue. You're probably not the only one, but is it worth staying the course on this piecemeal shot, or should you look at the one and done option? We get into that conversation next. Oil prices spiking after OPEC Plus members announced a cut to production by an additional 1 million barrels per day.
Just taking a look at what Wall Street analysts are saying about this surprise announcement, they are basically now expecting oil to go up through the end of the year.
Yes, of course. Whenever you increase the price of the base product, crude oil, that goes into making gasoline, it's going to get worse. What has been a very slow-burning Cold War between Saudi Arabia and the United States.
We have to see how this OPEC news sort of trickles in, whether it will create winners and losers again based on the rise in oil prices.
There's some people are pointing to this cut and saying, well, look, it's going to be taking so much production out of the market through the rest of this year. Regardless, OPEC is focused on stability in the market here. They don't want choppiness. They don't want volatility.
Elevated energy prices, another recession factor there.
Of course, the big question is what this means for the Fed's fight against inflation.
It actually sort of confirms that we're likely to see 2 25 basis point hikes, with oil prices likely to be moving higher. Inflation will continue to be a thorn in the Fed's side. I think the real question is, how deep will the recession be? And I think one of the main factors will be, how long does the Fed continue to raise rates?
A second Omicron-specific COVID vaccine booster shot is on its way. Federal regulators have authorized a follow-up booster for those who are at least 65 years old or those who have weak immune systems. Now, this comes in an effort to provide additional protection from the virus. But are U.S. consumers vaccinated out when it comes to COVID? Well, Yahoo Finance took a Twitter poll to ask, if you've received a COVID-19 vaccine booster, would you get another Omicron-specific booster shot? Of the 641 polled, 71% said no, they would not take another booster. Well, some of the leading biotech companies are in Washington, D.C. right now at the World Vaccine Congress to showcase their next-generation vaccines that are revolutionizing infectious diseases. GeoVax Labs is at the center of this, and their CEO, David Dodd, joins me now. Good to see you, David. Thank you for joining me. So I want to first, I guess, get a pulse on some of the conversations that you're having at the moment, because a lot of people, investors, are showing an interest in the healthcare space, but biotech stocks have been beaten up over this past year.
Indeed, they have been. They've been beaten up harshly over the past year. In fact, most of our peers were furloughing both programs and people, while we were able to add $37 million to our balance sheet and accelerate and expand 2 phase 2 clinical programs and all. So, for some, it's all about being able to separate yourself and to talk about the value that you're hoping to be able to deliver.
And obviously, we're coming at the tail end of the pandemic for most of the world here. So I want to ask you about this, the Yahoo Finance poll. A lot of people not interested in taking another booster at the moment, but talk about your technology, because you're producing a one and done. You have clinical trials for a one and done COVID booster shot. Tell us more about that.
Sure, and thank you for asking. Well, we have a vaccine that's in phase 2 clinical development as a COVID-19 vaccine. It has several attributes that differentiate it very strongly from the current vaccine, specifically the mRNA vaccines. That's from Pfizer and Moderna, as well as those from AstraZeneca, as well as Johnson & Johnson. The difference is that our vaccine utilizes as a platform an existing vaccine, which makes it unique because it enables it to have a stronger immune response in general, which provides you the opportunity to deliver a single dose vaccination. And we've been able to demonstrate that in numerous instances. We're also specifically focusing on the patient populations who are individuals with compromised immune systems. You mentioned this in your lead-in. There are about 15 million people in the United States who, due to having various blood cancers, they could be renal dialysis patients, they could have sickle cell anemia, HIV, et cetera. But these patients, their bodies have been ablated from the ability to mount a response to traditional vaccine stimulation. And that's where it becomes critically important to be able to address both the antibody side of the immune system, but even more so the T cell or cellular side. And that latter part is what we do differently than the others. We do the same in terms of targeting the antibody, but we have a very strong focus on T cells, and that enables us to provide greater durability and a broader breadth of immune protection And we're actually presenting here at the World Vaccine Congress the initial results of our vaccine in a direct comparison to the mRNA vaccines among blood cancer patients to demonstrate that there is indeed a difference, and it's in the favor of the type of vaccine that we have.
Would you be able to give us a little preview of that? Because a lot of people do have vaccine fatigue, so they're really looking for why should they be doing this? What is the next generation looking like?
Well, I think vaccine fatigue is real among all of us. I think even those of us who don't want to admit it. I mean, we've had 3 long years of dealing with this pandemic and 2+ of dealing with vaccines, et cetera. And we've seen continuous more boosters, while at the same time the durability is waning greatly. We actually have a phase 2 clinical study underway right now among healthy individuals where these are individuals who received an mRNA, so either a Pfizer or Moderna vaccine as their initial vaccine, but as a booster, they're receiving our vaccine, which again induces a broader, more durable immune response because we believe it will provide a greater preferred booster and not be required to have to keep coming back as frequently. We're looking at 6 months to a year, and the current boosters are lasting at best 3 to 4 months.
And David, obviously this COVID was a wake-up call for preparedness for the next superbug, for example. And we know that you met with the biodefense team with the White House officials. They talk about what transpired there and really what does the next phase of vaccines, what are you trying to address with the next phase of vaccines?
Sure. Well, fortunately, our government and other governments of pretty much democratic countries around the world are all highly focused in recognizing that there are threats out there. Call it bioterrorism or call it biodefense. And you're right. I recently did have the opportunity to be in the White House meeting with various representatives there about what do we need in the next generation of vaccines and other technologies from a biodefense standpoint. You're hearing a lot in the news about the Marburg virus, about Ebola viruses, et cetera. Those are at the top of the list from a biodefense standpoint. They carry fatality rates of 50 to 90%, depending on the strain. And that differs from COVID-19, which had has a 1.5 to 2.5% fatality rate. These are very deadly viruses that we're concerned about that could be weaponized. And because of that, we need platforms that can deliver as closely as possible, be extremely safe, be able to be highly efficacious, but also to the degree possible, be able to provide not only in a single dose, but also in a non-frozen state. Much of the world happens to be in environments in which they can't deal with highly frozen state vaccines. And we're right in the middle of that. We're presenting here at the World Vaccine Congress this week also our Marburg virus through non-human primates, which has shown excellent results, and also our
We appear to have lost our guest there, but a big thank you there to David Dodd, GeoVax CEO. Thank you for joining us from the World Vaccine Congress. All right, coming up, those who predicted home builders would scramble to finish projects ahead of a recession weren't exactly on the money. Inventory is still down in major metropolitan areas. Is it getting any better? We look at Manhattan next. TikTok takedown. The social media company recently under scrutiny over its Chinese ownership and allegations it could be used in influence campaigns or for surveillance. But if you're wary of the app, how do you delete your data from TikTok? Let's get the tech and legal perspective with Yahoo Finance's Dan Howley and Alexis Keenan. So Dan, let's first start with you. Walk us through how you actually delete your data on TikTok.
Yeah, it's actually a relatively straightforward process. Basically, you can go into the app itself and you're going to go to your profile page. And this is if you totally want to delete TikTok in its entirety, your account, not just the app itself. So you're going to go to the profile page and you're going to click that little hamburger, the 3 vertical lines in the top right corner. And from there, you're going to go down to the account and then privacy and settings. From there, you'll hit that account button, like I said, and then select deactivate or delete your account. So you can deactivate your account, which means you basically just put it on hold for a while, but we want to delete. So on the next page, you're going to go to submit a reason for deleting your account. If you actually want to submit it, you can just hit skip if you don't want to do that at all. And then on the next page, it'll ask if you want to download your old TikTok content. So your videos, anything you may have posted, you'll be able to download because, look, sometimes those videos are kind of funny. If you don't want to, though, you can just skip it. You'll kiss them goodbye entirely, and then you'll be able to go on to a page that will basically inform you that for 30 days, TikTok will still hold on to your data. The reason for that is, again, it's part of the retention process. They want to kind of keep you in. So they'll say you have 30 days to come back if you want to. You don't necessarily have to make this decision now. You can delete it. And then if you want to come back, we'll still have all of your stuff. If you want to skip that, go ahead and skip it, and then you can finally permanently delete your account. And as I said, once you do delete it, you'll still be able to reactivate it. So if you're trying to, quit cold turkey, I suggest deleting it from your phone as well.
Good luck. I mean, it is hard to quit, especially if they add that little 30-day window in there as well. So Alexis, obviously Dan described it there. The deletion process seems straightforward, but TikTok and other companies are in some places legally required to offer deletion. So Alexis, tell us more about that.
Yeah, Rochelle. So it really depends right now where you reside, though the fluid borders of the internet, they may spur some companies to adopt a one-size-fits-all policy so they don't have to piecemeal follow the law in every jurisdiction. So right now, consumers abroad, predominantly in the EU and in certain US states, have the right to delete their accounts, whether that's TikTok, whether that's another platform, along with the personal information that they've put onto those accounts. And those rights, they come from data protection laws that include the right, what has come to be known as the right to be forgotten. There are terms embedded in some of these laws. Now, in the EU, you have the GDPR law. There, consumers have the right to erasure of personal data, and they can do that erasure just by withdrawing their consent. In the US, on the other hand, that is a piecemeal jurisdiction here. We have a number of states that have adopted laws with these deletion type of rights. And in force right now is the front runner, the first state to adopt this really comprehensive type of legislation in California. Also, laws in force for deletion in Colorado, in Virginia, and then forthcoming are laws in Utah that'll come later this year, in Iowa in 2025, and also in Connecticut, though these laws, they really do differ on how they define personal information or personal data. In California, personal information comes down to information that identifies the consumer or even a household, or could be linked to either of those, but it pertains only to the information that businesses collect from the user. Even broader is Virginia's newer law, where consumers have the right to delete personal data, which includes personal information that the business can get not just from the consumer, but also from other sources. So kind of a sweeping right there, and Virginia going a step further than California. But still, for TikTok specifically, given that the company's parent, ByteDance, is in China, no guarantees about what data is still perhaps housed in China. U.S. Congress deliberating heavily in recent hearings over that information and whether or not the company's promise to secure the data with U.S.-based Oracle is going to be enough to satisfy lawmakers here. Rochelle?
So certainly still a lot of gray area here. And Alexis, even if you do have the legal right to delete your data, there are, of course, exceptions as well. Tell us more about those.
Yeah, there are. So as for Europe, for GDPR, there are things like right of freedom of expression that can trump the right to have your information deleted as a consumer. Also, if there's a legal obligation to keep the data, that is required in Europe as well, I should say the EU as well as in the United States. Also, things like allowing a user or a party to perform and finish off performing a contract. Those types of things will be exceptions to the general rules. There are a lot of them, but there are very particular requirements there. Things like public health, public interest, scientific, historical facts, those types of things sometimes would let a company hang on to your user info.
Yeah, it's still a lot to wrap your head around. And as you mentioned, the fluid borders of the internet making it that much harder. Yahoo Finance's Dan Howley and Alexis Keenan, thank you for breaking that down for us. Right, to housing now. The pinch in available homes for sale hitting the Big Apple as relatively low levels of inventory presents a hurdle in real estate deals in Manhattan. Here with the details is Yahoo Finance's Danny Romero. Danny, what are you watching?
Rochelle, it's not a pretty picture out there in Manhattan. Sales are down, prices are down. Not a great combination. A report from Douglas Elliman and Miller Samuel says that New York City market is really in the correction mode after the pandemic boom. So the question really remains is what will be the new bottom for this market? And that really depends on whether or not the Fed will hold rates. Brokers are really anticipating that the spring season will bring a lot more home buying activity. But again, that really goes back and dependent on those mortgage rates. We've seen mortgage rates on the downswing. If we look at the 30-year fixed mortgage rate today, it is sitting at 6.4%. That's what Mortgage News Daily says. But staying in the New York City market specifically, you know, the gap between sellers and buyers really is driving a wedge in the market when it comes to price expectations. Sellers are not slashing their prices at all. And there's low inventory on the market. Not a lot of people are listing their homes. And so some buyers are really waiting on the sidelines to really see some of that price reduction, which really isn't happening. But in the higher end market, specifically in New York City, we've seen a lot of action there. There's bidding wars that are happening. Wealthy buyers are also paying a lot of cash up front for a home. So they're not really being affected too much on by higher mortgage rates. But staying on the inventory side of things, that is still a big issue at hand. And that could be good news for home builders. We've seen a lot of movement there in that market, a lot of new homes being built. And we've also seen a shift in demand when it comes to that. A lot of home buyers are really looking at new homes because one of the reasons I've heard is that they won't have to really renovate their home later on. And those prices, those costs can really rack up pretty high. So they are looking at the new home market right now. And another thing too is that there's also a shift in the market when it comes to the demographic of who is buying a home right now. A lot of millennials have become home buyers and are homeowners now. The average age for a millennial to buy a home is around 34 years old. And a lot of factors weigh into that, Rochelle. For one is when you hit 34 years old, on average, some of these people are making six figures. So they're able to save up for that down payment. A lot of them also moved in back with their parents to save up for that down payment. And they're also receiving, some of them, financial support from their parents. But again, inventory will still be the issue at hand.
Indeed. Interesting to see those millennials, they're ticking up, but baby boomers still have that tight hold on the housing market. Danny Romero, thank you so much. All right, well, before we go, let's get you a final check of the markets. Still seeing that selling action continuing here. We're seeing the Dow near the lows of the day. They're off more than 220 points now. S&P 500, they're also down about 0.5% on the day. Tech-heavy Nasdaq still also lingering near the bottom, but picking up a little bit more than some of its compatriots here. Just down about 4.4% on the day, or 50 points. Well, that'll do it for now. I'm Rochelle Akufa. I'll be back with you at 11 a.m. Eastern. Until then, I'll see you soon.